what would be a massive tie-up, and given the size of these two companies and the combined entity, how large that would be, the knee-jerk reaction is, what kind of regulatory scrutiny is this going to run through? Is it pointless to even talk about? Will it even get off the ground? Of course, those are some big questions hanging over this.
It also is, honestly, something everyone's been talking about, which is there needs to be consolidation in the media space at a time where people are taking a look at their streaming bills and saying, what happened to the bundle? We kind of liked it. I mean, seriously, how many subscriptions do you have to different media services?
At least 10, probably.
Right. And if you're paying $8 a month?
I don't like to think about it.
I know, this is the reason why I think they get to keep doing it. Although, when the price increases come down the pike, maybe people start to cancel things.
The deflation finally kicks in.
Exactly. China, meanwhile, set to halt exports of a number of rare earth technologies, ramping up competition with the U.S. for strategic raw materials. The decision will impact materials involved in everything from wind turbines to military tech to electric vehicles. China accounted for more than 2/3 of mined rare earths last year. It holds around 85% of global refining capacity. This according to U.S. government officials, and it comes at the same time that the U.S. is talking about the mother of all sanctions if China were to attack Taiwan in some capacity. At the same time, when we're hearing reports that Biden is thinking about possibly increasing tariffs on electric vehicles from China.
And you think about where these U.S.-China tensions are really playing out, both in the flow of goods, but also the flow of raw materials, such as the rare metals that we're talking about. And the U.S., you think about the U.S. side of things, this is China's move today, but President Joe Biden, he's really been trying to generate more of this supply domestically, but you think about the huge role that China plays and has played for decades. It's a long timetable.
Especially if they have the raw materials, right? And this raises this real issue. Where else are you going to get them? And who is sort of a worthy partner as the U.S. tries to shift more to electric vehicles and some of these other renewable energies? Meanwhile, after a week of pushback from Fed officials on the rate cut trajectory, Philadelphia Fed President Patrick Harker saying the central bank should begin to cut interest rates, saying, quote, "It's important that we start to move rates down. We don't have to do it too fast, and we're not going to do it right away." Basically, we're in. Harker's comments coming ahead of the latest read on the U.S. labor market with jobless claims due in about 2 hours. I love it, Katie. They kind of try to push back. No one listens. They try to push back again. No one listens still. And they're like, all right, you're right. We're going to cut rates.
Yeah, and it is important to note that, I mean, Harker, he won't vote on policy next year. But in this environment, again, with convictions so high in one direction, every single scrap of Fed speak is being parsed at this moment.
The thing that frustrates me is, does it really matter if they cut in March or if they cut in April or if they cut in May? I mean, essentially, if they cut the same number of times, or if they are having the same parameters of cutting just in terms of disinflation coming down, then does it really matter how much or when, right? Are people getting a little carried away with that? And is the Fed trying to push back on that? But does it even matter to the price action that we've gotten? Because essentially, if the Fed is showing a willingness to try to adjust their restrictiveness to allow for a soft landing, doesn't that completely change the paradigm from people who are worried about the Fed killing the rally?
I think that's a great point. What's the difference between a month or two? And also, will rate cuts really matter for this market? It feels like rate hikes, 500 basis points of rate hikes didn't really matter. We're looking at potential records on the S&P 500. Will rate cuts matter, or is that just an excuse to rally?
Let's ask that to Jill Moek, AXA Group Chief Economist and AXA Investment Managers Head of Research. Let's go there, Jill. Do you agree that rate cuts really matter in terms of easing financial conditions, considering that on the way up, each hike didn't seem to materially tighten financial conditions?
Well, yeah, the question may be whether this loosening in market conditions is not happening too fast. I mean, I constantly look at market pricing for 10-year yields in the U.S. in real terms. For instance, they are barely at 2% now. The spread on corporate bonds has actually tended to narrow recently. So my view here is that, yeah, maybe it took more time than usual for financial conditions to get to where they should be to tame inflation. But the speed at which they are correcting right now makes me think that the market is getting a bit ahead of things, to the point that it could actually make it harder and not easier for the Fed to be accommodative next year. Because if the market goes too far on its own, then the question will be, what more does the Fed need to do to make financial conditions more palatable? So there's a loop, there's a dialogue between the market and the Fed. And honestly, at the moment, I'm wondering if the dialogue is getting us to, let's say, a reasonable position.
I want to talk about financial conditions a little bit more and how one should actually measure them and how the Fed is doing that, because you have these market-based measures of financial conditions which show pretty significant easing, especially over the past 2 months with this risk asset rally. But I feel like we've heard from Jerome Powell and others that really the thing to watch is real yields and the direction of travel there. What do you look at to judge financial conditions?
Well, there are many yardsticks, but a very simple one, which I've been using for a long time, is to look at where 10-year yields are in real terms relative to what is probably the U.S. potential GDP growth rate, which consensus has it at around 175%. So when you get real 10-year yields getting close or below 2%, it's getting hard to say that financial conditions, at least across the curve, are still in restrictive territory. We are flirting basically with neutral financial conditions if you use this very simple yardstick.
And if we are flirting with neutral financial conditions, what does that translate into in terms of rate cuts? Does the Fed necessarily have to ease so aggressively as the market is pricing in if we are indeed near neutral territory?
Yeah, that's my point. I think there's something a little bit hard to reconcile right now in how the market is pricing the trajectory for monetary policy next year. Because if for the Fed to cut by as much as what the market is right now, you probably need to be in a situation where precisely financial conditions would remain far too restricted, and where the economy would probably need to be much worse than what the consensus had. There's something which doesn't add up to me. To get to the kind of rate cuts that the market is pricing right now, you probably need to be in a situation where they will do an outright recession in the US. That's not what the market is pricing. If you believe that there's going to be an outright recession in the US, then yes, probably current financial conditions are still too restricted. But if you believe that there's going to be a soft landing, which seems to be the consensus right now, then, as I said, financial conditions today are probably already pretty neutral.
So you don't believe in the transitory story?
Sorry?
You don't believe in the transitory story, that really inflation actually was transitory, it just took longer than expected, and it will continue to go down just simply as a year-over-year comp and supply chain resolution issue?
I'm possibly overcorrecting because initially I was in the transitory camp. It took me time to acknowledge that, yes, we were faced with persistent inflation. So that probably makes me a bit reluctant to say today that, yeah, it's fine, inflation is going to normalize on its own. So we all learn from our past mistakes, and we probably tend to overcorrect. But I still believe that the burden of proof should be on making sure that inflation is going to go all the way to 2%. And it's not that clear today. I know it's a very simple view, but if you break down core inflation in the US between durable goods prices and services prices, you still have an acceleration in services prices excluding rents. And that is normally the expression of the domestic engines of inflation. So it's very hard for me to say right now, it's fine, all the engines of inflation are switched off, things are going to very nicely glide towards 2% without much additional effort. It's possible. My own forecast is that, yes, we will get to 2% inflation by 2025, but not with the kind of financial conditions which is currently priced in by the market. Because if we go that fast into recreating traction for the real economy, I'm not sure we'll have the slowdown in job creation that we need to see for services prices to really decelerate.
And this is why a lot of people are worried about inflation reigniting. Gilles Moek of AXA, thank you so much for taking the time. As markets do run away with the idea of rate cuts next year, now pricing in 6 rate cuts through the end of next year. I do wonder, Katie, when you look at the disinflationary narrative, how much has secretly been driven by lower oil prices?
That's the thing. I mean, I know that, there's plenty of ways to strip out the impact of oil, et cetera, all the various measures of core. But you think about how people feel inflation, what actually informs inflation expectations. It's food prices, it's oil prices, how much it costs to fuel your car, how much it costs to heat your home. And I think that just feeds into everything.
Yeah, especially given the fact that that's transportation costs. That's when it comes to, just sort of driving to work. That's sort of the goods disinflation side. Although that said, we did hear even from General Mills and others yesterday that they are seeing less demand. So again, it's just a hard economy to kind of parse through to understand where the drivers are going to come from.
I mean, you go back to what we heard from the Walmart CEO, I forget when that was, it feels like a month ago, saying to expect deflation next year, at least when it comes to the specific segment of the goods that Walmart is selling. But it's going to be interesting to hear from more of the C-suite at some of these big box retailers and beyond about what they're expecting in terms of their own pricing.
Yeah, definitely something that we keep talking about. Coming up, we're going to be speaking with Richard Fishman of MoffettNathanson on talks between Paramount and Warner Brothers Discovery. I do want to bring this to you, just sort of confirmation that China does plan to halt the export of a range of rare earth technologies. This coming as a tit-for-tat escalates. We'll be having that conversation coming up as well as we try to understand what the implications are at a time that's highly fraught with geopolitical conflict. Right now, we could say oil prices a bit lower, stable, with a lot of people wondering why they're not responding more to the Houthi militant attacks on carriers going through the Red Sea.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
There's going to be consolidation in media for sure, especially amongst the streaming names. Don't know when that happens. It's probably over the next few years. Obviously, you have an FTC, which has been allergic to consolidation. That, of course, may change, but it's inevitable.
That was, of course, Chris Marenghi of Gabelli Funds predicting consolidation in the media industry. When he joined us about a month ago, if you wanted to know, the media industry is consolidating. We yesterday learned that Warner Brothers and Paramount held talks about a possible merger, a deal putting potentially the studios together and putting HBO and CBS under one roof, according to people familiar with the matter. Robert Fishman, senior research analyst at MoffettNathanson, writing this morning, we hesitate to see the upside in any transaction for the Paramount company as a whole, especially at its current premium valuation, given the pressure on the linear TV business. It's a great place to start, and Robert, I'm so pleased to say, is joining us now to discuss. Robert, that is my key question. What is the advantage to tying up CNN and CBS?
Good morning. Thank you for having me. I think the answer to the question right now is the desperate times in media landscape, and the companies are facing significant challenges from a linear TV perspective, given the increasing rates of cord cutting. Linear advertising, we think, is in secular declines right now. So all these companies are looking to really just cut back. And back to your conversation earlier, try to figure out how to get to this other side of the streaming pivot that they're all making. But it's a really challenging time right now.
So do you think that this is a viable deal, or do you think that this is just basically the CEOs throwing in the towel and saying, we'll talk to whoever we can to try to understand what could potentially work?
I think every company is really trying to figure it out right now. And I do think that combinations are likely to happen. Do I think that anything is going to happen in the very near term? We have our skepticism just because of the regulatory landscape that was just referenced.
And something that I've been wondering about, thinking about this potential combination, is how Warner Brothers would actually pay for this. Because as I understand it, they have a pretty hefty debt load. You think back to that massive merger between Discovery and Warner Media from 2021. How would they actually fund this acquisition if it happens?
Yeah, we're still waiting to learn more details in terms of the actual terms and how it would be structured. I mean, clearly that they would likely look for some sort of stock component, if not a significant stake in the combined companies. So we still need to figure out the exact combination. But to your point, all of these companies are in a challenged position right now because of the debt loads that they have. And that has limited the flexibility that these companies have as they're coming through this streaming pivot that they're looking to make and trying to get to the other side with the pressures of the linear ecosystem going against them.
And if I were in the C-suite at Netflix or, say, at Apple's streaming arm, should I be worried right now? Not particularly just about this potential tie-up, but potential consolidation to come?
Well, from the digital company's perspective, in terms of streaming specifically, I mean, clearly, I would flip the question around and I'd say the media companies should continue to be worried to see how much bigger and stronger the digital companies are getting in streaming, especially with public reports that Amazon continues to be looking to go more in sports. And I think the whole sports angle here is a really interesting angle because what Warner Brothers Discovery does not have today is a broadcast network. And what we know that they're looking to do, a big deal coming up in 2024, is going to be the NBA renewal. So sports, I think, is a critical piece to all of this potential consolidation question, and how that plays out and who owns what assets will be have a significant impact on the future of the sports landscape as well.
That's exactly where I was going to go, especially with CBS. I wonder how much that's part of this idea of trying to get in, especially before Amazon, as they bid on this. If Amazon or one of the other streaming networks were to get a hold of some of the rights to the sports teams, or football in particular, would that be the death knell for the cable channels?
Well, to some degree, it's already happening. Yeah, Amazon does have their Thursday night package, and they've succeeded so far this season. We've seen real momentum there in terms of viewership. So yes, I mean, this is the trend for sports. Sports is going over the top. Clearly, ESPN remains the pivotal piece to the sports ecosystem. And there's been lots of discussion in terms of the timing of when they're going to take their flagship network over the top as well. But all of these sports rights are a critical piece, again, to the future of the media landscape and to the whole sports ecosystem. And the digital players play a critical piece as part of that as well.
I have to say, as you're talking, Robert, it does not sound very optimistic for a lot of these streaming channels that are not Amazon or that are not Netflix. And I'm wondering if the best game plan, according to you, is just to basically put all of the sort of repertoire, all the different shows together, give it as a streaming offer that is only one stream, it's a bundled stream, and just offering it like that rather than trying to compete in any kind of material way with the content as well as just the pocketbook of some of these other players.
I mean, we do think that reaggregation on the streaming side is inevitable. It will likely take some time to play out, but this potential consolidation or whatever permutation you want to throw out there is all one step closer to that end goal.
And let's talk a little bit more about Paramount specifically, because it was interesting to see this news yesterday about Warner Brothers. When you think about what else we've heard and learned about Paramount this week, of course, holding talks once again about a sale of the Black Entertainment Television Network, for example. We'll see if any buyers emerge there. Can Paramount stand alone as a standalone company? If it's not Warner Brothers, for example, do they need to be acquired by someone else at this point?
Yeah, I mean, I think the challenges at hand are real and growing. We hosted a conference a couple weeks ago now in terms of the future of the impact of Charter deal, the Disney Charter deal on the rest of the ecosystem. And we believe, and it's been reported, that Charter deal with Paramount is coming up. But all future renewals for Paramount, given what we say, essentially back to sports, that the fact that they're leaking all of their premium sports rights, including the NFL, over the top, is going to be a significant challenge going forward for Paramount. And we think that the renewals will come under pressure because of that. And that will be another leg as far as what some of the risks are facing this company. Coming back to the advertising story, it's a real difficult time right now. And it's pretty clear to us that television is in secular decline in terms of advertising. And that's going to put another significant challenge ahead, given how high margin these dollars are and the exposure that the TV networks, TV media business is for Paramount is generating essentially all of their profit today.
And of course, the talks between Warner Brothers and Paramount, they're preliminary, according to people familiar, may not lead to an agreement. But let's say that it did, that these two companies did combine. On the surface level, there's a lot of overlap between these two companies. What could that potentially mean for restructuring and layoffs, for example?
I mean, there would clearly be significant cost synergies involved in the combination of these companies. But in the report we published this morning, we alluded to the fact from an overlap perspective that the cable network business would be something with high concentration. So that's clearly something from a regulatory standpoint that we would imagine is reviewed at the very least. Again, in this potential speculative type of combination. And then you have to question what ends up with the two different studios. Whether or not Warner Brothers Discovery would be forced or even opportunistically look to get rid of the Paramount studio as well.
Robert Fishman of Buffett-Nathanson, thank you so much for being with us. Katie, I thought you brought up a great point about the debt and why this is sort of one of the key issues and obstacles to getting a deal done like this. How do they pay for it, given that they already have pretty significant debt loads right now? I'm looking at Warner Brothers, and the total debt is something like $45 billion.
It's a lot. That is a chunk of change and then some. But this is really David Zaslav's MO, growth by acquisition. Maybe a little bit surprising that we're pursuing another huge acquisition here just 2 years after what we saw with Discovery. But at a certain point, you think about how much debt, $45 billion, going to create some really interesting thought exercises for how this potentially would work.
Especially considering that both kind of need each other to get enough critical mass to be able to survive. We'll be talking more just generally about the mergers and acquisition landscape coming up, especially considering that this year, I think, was the first year in a very long time that the total acquisition amounts was something under $3 trillion. I mean, it was a pretty sluggish year. It should be more active, especially as companies realize that it's kind of now or never as we head into the next phase of the economic cycle. Coming up next, we've got Stuart Kaiser of Citigroup with some really interesting thoughts of how to play a rally that has absolutely been turbocharged into year end.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, you know, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
You asked the question, where did all the bears go? And I think we know. The Fed shot them.
I think there's an uber amount of optimism coming out.
When we look at all of these markets, we're kind of priced for perfection.
Let's just enjoy this calm right now, because I think it's going to get a lot rockier and a lot more uncertain.
The question is, you know, does the party stop? I think most folks think it doesn't stop.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What was yesterday? How did we understand some pause in the rally that was rip-roaring until a sudden dramatic swoon? Do you blame some sort of boogeyman? Do you just say it's people packing up their bags and going home? Welcome back. This is Bloomberg Surveillance from New York City, live on Bloomberg TV and Bloomberg Radio. Tom and John are both off today. They started their year-end festivities early. I am so pleased to say Katie Greifeld alongside me. I'm Lisa Abramowitz. And really, how much can we really glean from yesterday's sell-off that was the biggest going back to September?
Not a whole lot. I mean, as you pointed out a little bit earlier, you didn't see any reaction in the bond market. It really held on to its move that had started earlier in the day. So that obviously tells you something. The fact that we were very overbought on a number of measures tells you something else. And the fact that it happened at about 2:30 p.m. on December 20th also tells you something, that there just weren't a lot of people around to be trading.
Yeah, I do wonder how many people were just sort of selling out before they went on vacation. This does come at a time where pretty much everyone is optimistic. And if there is a dip, you buy it. That is essentially the word that we're hearing from Steve Kroner over Scott Kroner, over at Citigroup, saying, you know, we do expect some volatility, buy it. We've been hearing that from pretty much everyone. Does this basically set up for a risk case of people not being optimistic enough heading into 2024?
It's a great question. I mean, you think about the consensus of optimism right now and how that evolves. Of course, we do get some important data points just in the next 24 hours or so that will inform some of that heading into 2024. But I found a reason to care about what we saw yesterday. As of right now, over the past 3 days, the S&P 500 is actually down. Of course, we've seen 7 straight weeks of gains. If this loss holds, and of course, looking at the pre-market trading, there is some optimism coming back, that would be the first weekly quarterly loss in quite a while.
You did very well there.
I found it.
You found the reason to care. That would break the 7-week streak that was the longest going back to, what, 2021?
Yeah,
I
feels
believe.
like it.
So it's been definitely a streak to be broken. I think that's actually really good. You did really well.
Thank you.
8:30 a.m. we do get some data. Initial jobless claims come out. 1 p.m. we get a presidential press briefing with NSC's John Kirby. And before the market, we do get earnings from Carnival as well as aftermarket earnings from Nike. And to me, this is what I'm watching, frankly, is just what the corporate commentary is, given the fact, Katie, that we saw yesterday a number of companies warn about the macroeconomic landscape. We heard FedEx come out and talk about that. We heard General Mills talk about that. We've heard a whole host of others. So at what point do you start to listen to them just as much as you've listened to all of the economic indicators painting another picture?
Exactly. Of course, we're talking about anecdata when it comes to commentary from some of these big CEOs, but it's very, very important. You think about the view that they have on the consumer, the state of spending in this economy. I got to say, I am very excited for Carnival because you talk about optimism. There's a lot of optimism that's been priced into Carnival shares up, what, 124% in 2023. It's just amazing.
Carnival, the cruise line.
Yes.
Okay.
Yes.
Meanwhile, Citigroup is one of the most bullish banks heading into 2024, calling for the S&P 500 to reach 5,100 by year end. That used to be one of the most bullish calls. Now it seems like it's part of the crowd. Stuart Kaiser, head of U.S. equity trading strategy at Citigroup, joining us now. Stuart, I want to start there. Do you sort of worry that you're not getting bullish enough because the rest of the street's coming to you?
It's a good question. I mean, I'm definitely feeling more bullish post-Fed, I think, than we were going into the Fed. I mean, as you know, we've been kind of bullish, the last few months, expected a rally into year-end. The Fed feels like they've extended that window a little bit, just in the sense that they're being more respectful of the dual mandate and probably a little bit, quicker to come to the rescue, so to speak, if we do see weakness in the growth data. So, I think we're probably, I don't know if we're more bullish, but I think the bullishness is probably has a wider window to perform in going into 2024.
Well, the reason why I ask that is because if we're at 4,800, essentially you're not talking about that big of a gain through year end. And this comes as you're expecting the economic data to come in strong and to still show this disinflationary trend. So what would it take for you to boost that year-end target?
Well, I'd have to call up Scott and ask him to do that for us. But, I think, look, from my perspective, we still do have a modest recession in the middle of the year from our U.S. economists. So I think really the question here is, does that recession call continue to get pushed out as it did through much of 2023? And if that happens, and if the Fed is willing to do quote-unquote insurance cuts, then, then the markets are going to be much higher by year-end. And I really think that's one of the big topics next year is, A, recession, do we get it or not? And B, kind of what is the calculus for the Fed? If you'd asked me a couple weeks ago, I would have said the Fed might be too slow to react because they want to loosen up the economy. After the December FOMC, it seems like they're not going to be too slow to react, and that might just add a little bit of juice, to your point, as we get into next year.
Well, on the Fed's reaction function, are you basically saying that the Fed put is back or is it coming back?
I mean, that would be an initial takeaway from the December FOMC. I think my view, if you had asked me in November, would have been, they're not going to hike unless inflation hooks higher, and they're probably not going to cut unless we see meaningful weakness in the labor side of the economy. The December FOMC suggested, no, maybe there is this third option where they could actually be doing quote-unquote insurance cuts. And if they do that, I think that's extremely bullish for equities. I mean, if they're cutting in an environment, let's say, where we're printing 150K jobs, then, equities are going higher.
Well, something that we've been tussling with is how much rate cuts are actually going to matter. You think about 500 basis points of hikes, maybe causing a little bit of indigestion in the stock market at one point, not at all this year. We did have some turbulence over the summer. And then you think about the economy overall, rate cuts. Does the why for why we're getting rate cuts actually matter when it comes to this equity rally?
I think it does 100%. If they're cutting because they're seeing real weakness in the labor side of the economy, that's much different than if growth is sort of sideways, inflation's easing, and they decide, hey, we're too restrictive. So I think the why matters significantly, at least in my view.
At this point, though, there is a question about earnings. And I know that you say bad news is bad news and good news is good news. Have we really gotten such good news on the earnings front? I'm going to be speaking with Emily Rowland later this morning, and she basically pointed out that year-on-year S&P 500 earnings barely grew, 0.6%, and a lot of the gains that we've seen are pricing in next year gains that are expected to be robust. Doesn't that concern you?
It does a bit. I would say I think year-on-year we're tracking down about 2% for S&P. But if you had asked us last December, what is the risk to S&P earnings? People were throwing around 200 numbers or sub 200 numbers. So, the year-on-year growth isn't great, but the way the data printed relative to expectations has been, very, very, very positive. So I think that's how I view earnings this year. As we came into the year with people throwing around $185 to $200 bear market type, situations on EPS, we're now going to print something that looks more like 220. Scott at Citi is at 245 for next year, which is, going to give you pretty close to double-digit EPS growth in 2024. So not too worried. I think if I had to describe 2023, better than feared. And then 2024, it looks like hopefully we're going to get some actual, not only EPS growth, but a broadening out of EPS growth to a larger number of sectors, which we do think is also important.
Exactly where I was going to go. We had Margit Patel on earlier and saying, maybe that story's a little overplayed. Other people still sticking with what's worked, including big tech. You're kind of taking a little bit of a different tone.
Look, we thought big tech and growth was going to work at year end, and then as you got into 2024, you needed to kind of do a little bit of a reevaluation of things. And next year, if you do get broader earnings growth after a year in which you had very narrow large cap leadership, I think there's a fair argument to say that S&P equal weight, for instance, relative to S&P cap weight would make a lot of sense. What we've seen this month is Russell 2000 is massively outperformed. So I think what folks are saying is growth may be better than we expected. The Fed actually may cut without a recession. And I've got a lot of stocks at the smaller size of the cap spectrum that have meaningfully lagged. So I think that theme has legs. I do think Russell 2000 we're probably a little less comfortable with just from a risk-reward perspective, but definitely S&P equal weight relative to cap weight is something that we think makes a lot of sense into early next year.
So we're talking about some big, longer-term themes here. Of course, what the risks look like in 2024 and the opportunities. Let's talk about 2:30 p.m. yesterday. Of course, that sudden plunge that we saw in the S&P 500. A lot of people pointing to zero-day options and the heavy put volume that we saw there. What do you make of that argument?
Our view is that the zero-date options is probably less likely to have caused that yesterday. Just talking to the clients that we talked to on a regular basis, everybody was searching. Some people said, oh, it must be the 20-year bond auction. Oh, maybe it's just low volumes, kind of late in the month. People will throw zero-date options out there, I think, as a reason if they don't have another reason. It's an easy kind of fallback reason. So it's always possible that in a low-volume day, a small amount of flows can kind of get you going. And it does feel like the markets we're in now, once a direction is determined, we're just going to kind of go that way because there's not a lot of volume to push it back. So, we're not generally in the camp of blaming zero date for these type of things. Could it be one of a few things that got listed? Some people said, oh, delayed reaction to FedEx numbers. Some people said the 20-year bond auction. Other people said zero date options. This is just one of those, I think, late in the year, low volume, kind of we rallied a lot. Take some risk off the table.
I like the theory that it was a delayed reaction to FedEx because that would be quite a delayed reaction.
If you don't have an answer, I mean, I think people were groping yesterday.
Yeah.
And you just kind of, they're looking for anything, what has been bad news, theoretically, that we've received in the last couple of days that could have done it. I think the most notable thing, which you mentioned earlier, is equities moved, but other assets didn't. And I think that's why people were a little bit confused by it. It clearly didn't come from the bond side of the ledger. Some folks said there were just some, equity sell programs going through the system, and that might just be risk reduction into year end. Last year, we kind of had this a little bit too, though. We kind of rallied the first 2 or 3 weeks of December, and then the last 2 weeks of December last year were a little wonky. So maybe we're having that again.
So are you following Scott's advice, just buying the dip? Were you out there yesterday, just scooping stuff up, getting really excited?
I was trying to figure out what was happening. I think the buy the dip stuff makes sense. I think if you believe all the narrative we've had here, right?
Well, this is my issue. If you always buy the dips, there will not be dips. So is that what we're expecting? All the volatility that people are talking about next year, there's a high risk of it not happening because everyone's going to buy into any kind of volatility that we see.
It's possible. There's still a lot of cash on the sidelines. If you're a retail investor who's sitting in money market and you get told rates are going lower, you just missed a 20% rally in the S&P and a 50% rally in NASDAQ. And if you believe we're not going into a recession, I think there is the potential for money to start to bleed into the market, to your point, and kind of, a retail put alongside the Fed put maybe, kind of really improves your risk reward. But to me, it all boils down to labor market data. If labor market data holds in, you just want to continue to run long equity risk. If you see weakness in that part of the economy, you need to be really, really cautious about how you manage things.
Stuart Kaiser, thank you so much for being with us. Happy holidays, Merry Christmas, Happy New Year. Stuart Kaiser of Citi. I do wonder, especially as we're watching economic data coming out 80 minutes away, we get initial jobless claims. And given the fact that it's thin markets, if you're looking for a boogeyman, an interesting print there, That could do it.
Oh, yeah, you can definitely find one in a little over an hour or so. But he makes a great point that it really hinges on the labor market right now. And weekly jobless claims, again, we get them every single week, maybe take some of the excitement out of them. But still, as we're trying to really map out this labor market, very important.
Yes, we're trying to make something of them. And actually, a lot of people have been trying to understand them because the high frequency aspect of them. But yes, I take your point. Every week they come out, and pretty much every week they're bang on 200,000. Just now, taking a look at markets, you can see a bit of a lift. Maybe the buying of yesterday's dip after 2:30 p.m., 47.71 on the S&P. Yields basically where they've been all morning, 388.25. Crude a little bit lower. I find this really interesting. Quiescent, $74 on crude traded on the NYMEX, despite some of the concerns in the Red Sea. Meanwhile, what I'm watching right now is just some of these earnings coming in and trying to understand exactly what is going to pass as some kind of weakness, because we see CarMax coming out. We are going to, at some point, see Carnival coming out later after the bell. We're going to see Nike at a time where it's really been mixed.
It has been mixed. That's the thing. It feels like it's hard to get one consistent narrative, especially from some of these retail names. And we know that the forecasts in particular, they're always important. They've been particularly important as we stare into 2024. And if you've been missing on your earnings, if you've been missing on your guidance, you have been punished in this market, and that continues.
I'm looking right now at used vehicle sales coming in at $4.83 billion versus the estimate of $4.97 billion. The used car industry is so interesting to me. I'm hearing that there's going to be a drop in prices. We've been hearing this for a while, whether this is the disinflation, the deflation that you're talking about, how that factors in. It hasn't been playing out in numbers as much as I'd expected.
You know, used cars and also the housing market have been some of the most fascinating to watch this year. It feels totally broken on the housing market side, but hopefully that changes.
Why, you're looking to buy a house?
Always.
Coming up at 8 a.m., someone who can weigh in on the broken housing market, Peter Shearer of Academy Securities, as we try to get to year end with a market that is incredibly optimistic. We've brought forward some of the end year forecasts for the S&P for next year to this year, 47.71.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The Arab states seem very reluctant, as long as the Israeli-Gaza war goes on, to join in an American effort to suppress a group that is actually even more than Hezbollah, launching an actual short-range ballistic missile in Israel's direction. This is going to be a huge problem because our options here are not great. In terms of deterrence, we're already past that. The Houthis don't seem to be able to be deterred right now.
That was Aaron David Miller, Carnegie Endowment of International Peace, speaking with us yesterday with a fascinating point, talking about the connection between the Red Sea and the Houthi militant attacks to the Israel-Hamas war, given the lack of involvement from Middle Eastern partners of the U.S. to try to squelch some of these attacks. Welcome back. This is really one of the key issues as we try to parse through the geopolitical risks, and this is a really important conversation. I want to get right to it. Norman Rule joining us right now, Senior Advisor at the Center for Strategic and International Studies and former senior U.S. intelligence official. I want to start there, Norman, just how much you see this as a real issue, that as long as the Israel-Hamas war goes on, we're not going to get Riyadh on board to try to squelch the Houthi militants.
Good morning. Well, I believe that's certainly true, but at the same time, Saudi Arabia is unwilling to engage in a conflict with the Houthis that could lead to further escalation against Saudi Arabia itself, with a history in which the United States and international community did not support Saudi Arabia or the United Arab Emirates with defensive weapons when they were last under attack from this organization.
So at this point, how do you see this resolving, given the fact that there's a real reluctance to have offensive strikes by the U.S. on different Yemen targets, and at the same time, the Houthi militants have pledged to continue the attacks for the foreseeable future?
In the near term, the Houthis are likely to assess what they see in terms of both the maritime coalition and how they interpret international will and fortitude. Remember that Iran retains an embassy led by a former senior military officer in Yemen, and he's providing counsel to the Houthis, likely on how to handle the West. They're likely to test Western red lines, but they're not going to seek a catastrophic response from the coalition. Remember that we now have hundreds of missiles, hundreds of air defense missiles with an extraordinary array of naval capacity around Yemen, but inevitably the Houthis are going to seek to test our fortitude.
Let's talk about the Western response a little bit more. Of course, Bloomberg reported this week that the U.S. is considering military strikes against Houthi bases. Lisa mentioned the reluctance there, but when you think about what the West can do here, do you think that going on the offense is necessarily the right tactic to take?
Traditionally, the way the West has handled such attacks has been as follows. If a drone or missile is fired and shot down, no retaliation action is taken against the Houthis. If it strikes a ship and there's significant damage, or if there are deaths incurred, at that point, proportional attacks would take place. And that would mean a strike against the firing site in Yemen itself or elsewhere. There have been proposals that in order to deter these attacks, that multiple attacks would occur by the coalition against Houthis to reset deterrence. I think there's going to be a concern in Washington that would risk upping the escalatory ladder, and I don't think that's going to be the first choice.
And let's talk a little bit more directly about Iran. Of course, Iran's aggression through proxies. You write in your note that Iran continues to escape any international retaliation. In this scenario, what would that international retaliation look like?
Against Iran, very little. The West shows no inclination to risk a conflict with Iran or to risk Iranian retaliation against shipping in the Arabian Sea or elsewhere. So for Iran, in essence, it's launched its proxies throughout the region. The proxies are seeking to place Israel and the United States under siege and to touch the global economy to demonstrate their strength. Iran just needs to stand back and watch this play out.
In the meantime, Norman, we still do have the Israel-Hamas war ongoing at a time when we heard from Antony Blinken, Secretary of State, yesterday, when he said it's clear that the conflict will move and needs to move to a lower intensity phase. Can you describe what you expect to see in the weeks and months to come out of this conflict?
Well, in the near term, the Israeli forces are likely to lower the intensity of operations in North Gaza to a holding pattern. They're going to focus on Khan Yunis and the central area. This remains a very difficult challenge, and in some ways, the lower the intensity, the longer the conflict, because the longer it will take for them to eradicate Hamas leadership and military capability. But inevitably, there is going to be a pressure for Israel to drop the intensity, given the significant catastrophic human damage. It's not just that thousands have died, but approximately 1.9 million of the 2.3 million people who live in Gaza are now displaced.
And let's talk a little bit more about how the Red Sea, what's happening there, plays into, of course, what we're seeing in Israel and Gaza. Does this threaten to widen or prolong the conflict there?
I believe the conflict has already widened. We now have a situation where the Gaza conflict, started by an Iranian proxy, has brought in all Iranian proxies to the region. It's touched the global economy. It's shifted military configurations throughout the region. Countries are spending millions of dollars on defense and shipping adjustments that they didn't spend on October 6th. This is now a regional conflict, whether or not we are willing to characterize it as such.
And of course, there are some distinct and separate conversations happening around China right now. Of course, China reportedly saying to President Biden that there are plans at some point to reunify, their words, with Taiwan. But how do you think that China is watching the developments in the Red Sea right now?
China traditionally maintains a small counter-piracy force of approximately 6 vessels. However, these vessels generally only protect Chinese-related shipping, and in fact, there's evidence that at least 3 of the vessels ignored multiple SOS calls from ships under Houthi attack. So I think China is going to maintain protective posture for its own equities in the region, but avoid being drawn into what it would see as a military engagement in the region. Russia, which has a much smaller presence, will almost certainly follow the same path.
Given your experience, Norman, as a senior intelligence officer who's worked closely with allies, do you have a sense of how much the U.S.'s relationship with some of the allies have been eroded through all of these conflicts, especially in light of some of the conflicting messages that we've heard?
Well, to be clear, we're in a situation where an Iranian proxy that fires rockets and missiles against Israel, striking civilian areas, has received a vast amount of U.S. support. An Iranian proxy in Yemen that fired a vast amount of missiles and drones against civilian areas in Saudi Arabia received only U.S. condemnation. So there is a sense in the region that we tend to pick and choose situations, and we may not be the most dependable partners. This is an opportunity for us to reset that dynamic, but I'm not certain Washington is eager to engage in any significant regional involvement.
I just want to finish with the Israel-Hamas war and this question of, if the U.S. does not have the ears of Middle Eastern allies, what is the evolution of this? What is the end game? How does this evolve into something other than a catastrophic humanitarian mess, into something that is stable?
Well, to be clear, as I've noted, there is no such thing as a day after scenario. There is a months after scenario, because it will take months to constitute an Israeli government that is willing to deal with the Palestinians. It will take months to deal with to create a Palestinian government that's able to deal with Gaza in a situation. And we've got to come up with a security force and a humanitarian program to put into Gaza in the first few minutes of the day after. And that will take a lot of time to play out to see how that succeeds. So this is a long-term conflict, even if the violence were to end today, which obviously it will not.
Norman Rule, thank you so much for taking the time to speak with us at a time where we do have all of these multi-front geopolitical risks and these wars percolating, a couple different proxy wars, whether it's Iran or whether it's Russia. This is one of the main themes, especially heading into next year, given the fact that it's an election season, that the U.S. hasn't been able to always speak with one voice. I mean, we see that with Ukrainian funding. We see that with some of the dissent, the fact that all of the Washington lawmakers have gone home on holiday and are going to try to get something passed early next year.
Yeah, this is an extremely tricky moment for the Biden administration when you think about what's happening outside our borders. And I'll bring it back to that Quinnipiac poll we were talking about a little bit earlier. This Wednesday poll, it also found that support for sending financial aid to Israel to fund the war with Hamas is quickly deteriorating. American voters, they're concerned about domestic issues, and you're seeing that in these poll numbers.
And coming up, talking about domestic issues, we are going to be checking out the latest initial jobless claims. Yes, they are just a weekly number, but we watch them every week, and it is sort of a high-frequency view on the labor market and whether there are any cracks. The answer's been no, consistently, pretty much across the board. Will that be the same today? Coming up next, Sanal Desai of Franklin Templeton, as we try to get a sense whether there is any bearishness left or whether the Fed really did shoot them all, as we were hearing about a couple days ago. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
We're still trying to figure out what Jay Powell was really thinking when he changed his tune. And honestly, was it him being tired, him just being real and not realizing that it would really cause the market reaction, or maybe this is what he intended? Welcome back. This is Bloomberg Surveillance, where we parse through Fed speak a week after it, over and over again, because that's what the markets are doing right now. We are about an hour away from some key economic data. Before we get there, taking a look at markets, you can see that lift, get even liftier. 47.75, retracing some of the losses yesterday, the biggest one-day decline going back to September, with pretty much everything down except for 19 stocks. NASDAQ up even more. So that flight to the havens still very much present, up 0.7%. And the Russell 2000 up 1.1%. I mean, honestly, to me, this has been one of the stories underpinning all of this broadening out in the market action. Small caps are actually getting bid.
That's your poster child for the broadening out of this rally, because, okay, big tech, you can make the case that that's turned into a haven asset, but to see some of these small cap companies with their debt loads, with their more near-term maturities, really rallying out the wazoo here really tells you just what the sentiment has been like. And even though yesterday we did have that little hiccup at 2:30, we are still on record watch for the S&P 500. It could come by 2024. That's right at about 4,800. We're about a whisker away.
We'll just keep that wazooing right up and see if we get there. We're also seeing in the bond market that bid pretty persistent. Today a little bit off of it, but yesterday, even with some of the sell-off in the stock space, we did not see it in the bond space. And you could see that any kind of sell-off is actually getting paired back with more of a bid into the bond market. 10-year yields now at 3.8695%, if you really want very specific numbers. 2-year yields 4.36%. Really, it's you've mentioned this, Katie, the fact that we still see a very severe curve inversion. And when does that start to shift? That people start to expect the Fed to cut rates sufficiently to generate growth over the longer term. We're not there yet, because if we're calling the all clear, this implies maybe a more inflationary picture than the Fed would like.
Yeah, and we'll see how that plays out along the curve. It does feel like the center of gravity really along the entire curve right now is about 4%. Of course, your big outlier is that 2-year yield, but whether we get that bull steepening as rate cuts start, over in the summer, it looked like it was just the 10-year going up that was going to drive us back to positive. Obviously, the opposite dynamic at play right now.
We're under surveillance this morning. Let's get right to it as we try to understand the landscape heading into 2024. A mega deal between two media giants could be in the works. Warner Brothers Discovery holding talks in a possible merger with Paramount in a move that would unite CBS and HBO under the same roof. The deal still in a preliminary stage with no formal talks underway, just simply a lunch between CEOs. That's what we heard from Axios, with them both meeting in New York on Tuesday. Right now, unchanged on Paramount. Warner Brothers up at 1.2%. It's basically a mating of desperate companies. That's sort of what we heard earlier this morning.
Yeah, and it seems like media consolidation, that's been the rallying cry. That's been what people have been saying is going to happen. Maybe we are truly seeing it happen. And you think about how M&A overall has been pretty muted, but we've seen it in a big way in the energy sector this year, despite muted volume overall. Maybe we're going to see it in the media landscape. Whether it's these two actual companies tying together remains to be seen, but maybe a foretelling of what's to come.
And this has been something everyone's been talking about for kind of a while. So we'll see if they can actually pull the trigger. This story really caught my eye. Citigroup said to be exiting the distressed debt trading business in its pursuit of higher returns. The news coming on the heels of another announcement that it's getting out of the municipal bond trading and underwriting. Meanwhile, and this is sort of the other side of the same coin, Morgan Stanley discussing a potential move into a new private credit fund that would include capital from external investors. The bank holding preliminary talks about injecting $1 to $2 billion of capital into the new vehicle. The reason why I say two sides of the same coin, how much is it? Either you're all in or you're all out. You're either in, the capital-intensive distressed debt trading and investing, or you can't be because on a regulatory standpoint, it just isn't economic.
Well, it's clear where Citi falls, and I think it's so interesting watching Jane Fraser at work here. Of course, she announced in September, I believe, that she's going to be undertaking this big restructuring, and that has really picked up as we head towards 2024. The muni bond news last week, now distressed debt trading. And it's not like they were bit players in either of these markets. So it's big for Citigroup, but it's also big for these asset classes.
And Jane Fraser is definitely taking some bold moves and moving quickly. Meanwhile, the U.S. considering raising tariffs on Chinese electric cars, this according to the Wall Street Journal. The report saying the White House and other agencies are set to wrap up a long-running review of whether to uphold Trump-era tariffs on roughly $300 billion of Chinese goods by the early next year. The move would serve to insulate the U.S. green industry. So two things. One, this could potentially make it more economic for electric vehicle manufacturers in the United States. But two, it makes Biden look tough on China heading into the election.
And that is a popular thing to do. That is one of the few bipartisan issues left out there. But because we talk about Tesla all the time, and maybe this is revealing something about myself, you kind of forget how dominant China is when it comes to the global EV market. What a powerhouse it is there. You look at some of the numbers expected for next year. They're expected to account, China, for 60% of the world's new passenger EV sales in 2023, rather. So, of course, this has big implications for the EV market potentially, but it's already kind of hard to sell Chinese EVs here.
Which is by design, and Germany is looking at doing the same, especially after their car manufacturers took a look at Chinese additions and said, they're really ahead of us. Let's get straight to markets right now, understanding just how much everyone's thrown in the towel and gone all bull after the Fed meeting. Sonal Desai joining us now, fixed income CIO at Franklin Templeton, who's been a sobering voice for us throughout the year, saying, wait, let's just fully understand where everybody's minds really are at. Are you throwing it in terms of going full bull in response to the Fed?
No, I really am not. Here's the thing. A month ago, Powell told us that he might not need to raise as much because the market was tightening for him. I think the market needs to recognize that we're easing for him right now, massively. We have eased a lot. The economy is going to respond to that easing. And yes, the Fed is likely to cut next year, but every time the Fed announces cuts, the market doubles those cuts. Right now, we're anticipating pricing 150 basis points of rate cuts next year. I'm not sure that the data warrants that yet. I am a little puzzled that Powell took the decision of doing what I would consider, for a central banker, he threw caution to the winds. He essentially established, he announced mission accomplished for all practical purposes. So, yeah, I'm not throwing it in yet. I'm not going all in because I think the speed of the move has much more a sense of markets trying to predict the Fed's reaction function rather than markets trying to predict what's happening in the real economy.
And Sonal, you and I spoke last week after the Fed meeting, and I asked you about that reversal that it feels like we got from Powell from early December to last week. And you said that you were baffled, and I really liked that comment because it was so candid. Has the Fed speak that we've heard in the days since helped clear anything up, or what is the communication message of the central bank right now?
So right now, I think what really isn't clear is what the Fed's trying to do. I mean, I don't think did Powell really, after these last 3 years or the last 15 years, not know what the market's reaction was going to be? And I'm not sure the Fed, the subsequent Fed speakers, they haven't had the impact which perhaps they wanted to have. But at this stage, I still am not sure what impact they wanted. They clearly wanted a rally. Are they trying to fine-tune the extent of the rally that they wanted? Because this is now getting deep into markets and way outside what I think central bankers need to be doing.
Well, to that point, you think about the gulf between what the Fed is signaling and what the market is pricing in. The Fed penciling in 75 basis points of rate cuts next year. To me, that looks like normalization. You think about the market pricing in 6 rate cuts. That sounds like a recession to me. Where do you fall?
No, I think I'm going to actually go right now on what the Fed's telling us, which is about 75 basis points. I think 50 to 75, I can see that. You know, there's enough uncertainty on the pace at which disinflation occurs to make that reasonable. For 150, starting as quickly as the market anticipates, you need to have serious recessionary signals, at which point I'd really question these massive rallies that we've seen in risk assets, be it the stock market or be it risky assets, credit spreads, and so on in fixed income markets. There is some cognitive dissonance that we're seeing between the two sets of markets here. This feels a lot more the Fed's going to cut rates because inflation's going to come down, the economy is not going to slow, and they're just going to cut rates. And that seems to be a bit of a stretch.
Just quickly here, Sanala, what are you doing with this? How much conviction do you have to lean against some of the euphoria that we've seen?
So I think that if we see after tomorrow's PCE number another massive rally, I think I will have greater conviction to lean more decisively against it. We're certainly not chasing this rally.
Sunil Desai of Franklin Templeton, thank you so much for being with us and for your real speak. We always appreciate it. Have a wonderful new year and a holiday. Right now, we are getting some breaking news that Angola is exiting from OPEC. This according to the Jornal de Angola, and it comes after some consternation at OPEC Plus about whether it was going to cooperate with some of the production cuts that were put out for it. You are seeing a response right now in crude, Katie.
And you remember, of course, the latest meeting delayed, actually. Interesting to see crude reacting to this. Crude oil currently down about 1%. And if you take a look at the intraday chart, of course, spiking on the heels of this news. It'll be interesting to get more reporting on this, maybe some reasons why. We can draw our own conclusions, but of course, this is a developing story. And also, when was the last time a member country actually exited from OPEC? These are all questions I would like answers to.
I don't have an answer to that. It is a good question. This does, though, show me some of the division on OPEC Plus about cutting production, because these are some of the members in Africa in particular that are members of OPEC Plus that were concerned about cutting as much as Riyadh was hoping that they could to get prices up. If they keep producing more, this becomes even more of a supply issue, which we've already seen with the U.S. and could potentially flood a market at a time where people are worried about demand. But really, this has been a supply story ultimately.
Oh, big time. I mean, you talk about the non-reaction, it feels like, in oil to all the different geopolitical tensions in the world right now. And like Lisa said, it's really been a supply story. And it's a really tricky moment for OPEC. You bring up U.S. shale production just absolutely growing and growing. What that means, working against those OPEC supply cuts. And all of this is playing out in crude right now, currently hovering around $74 a barrel.
And the U.S., meanwhile, is pumping record amounts of oil, more than, I believe, a lot of the OPEC members combined. If you take a look at what we have been doing in the United States, taking a look at gasoline prices, and this to me is sort of an interesting litmus test, especially given some of the consumer confidence that came out yesterday. Prices are at $3.12 right now on average across the country, and that's from a high close to $4 earlier, just a couple months ago. So it gives you a sense of just how much much we've retraced some of those higher gas prices. If you are just joining the program, we can see a lift to the market up about 0.5% on the S&P 4774 following the worst one-day sell-off going back to September. Bonds did not participate on the way down, with yields lower yesterday. We could see them marginally up today. 10-year yields 3.87%. 2-year yields also just marginally higher, but still well off recent highs, which I find interesting given still a lot of the pushback to potential rate cuts. Going forward, though, this is going to be a question, right? Whether it is sustainable to get the level of rate cuts that people are pricing in if we don't get some kind of recession. And this was sort of the philosophical difference that I hear from Sunil Desai and other people who are saying, actually, the Fed is just saying that in response to disinflation, even without weakness, we can essentially cut rates. It's sort of the battle of transitory all over again.
And this Fed is one that's been a little bit communication challenged. I don't want to be rude, but just communicating what actually is motivating these rate cuts and the magnitude that we're going to get. I mean, in conversation with Sunil Desai, the point that 6 rate cuts, that looks like a recession. That looks like a little bit more than just normalization. Of course, we're trying to get back to neutral. 6 rate cuts in 1 year would be quite something to behold.
Communication challenged?
You know, to put it mildly.
Well, I think it was very confusing when Jay Powell said, yeah, we were talking about rate cuts, and then John Williams said we weren't really talking about rate cuts, and then what's really mean?
In a room.
I mean, it sort of raises this question of, you know, what message are you trying to send? We're a little bit all in a tussle. Coming up at 8:30 a.m., not in a tussle, Steve Rasciuto of Mizuho speaking to us after we get the initial jobless claims. Do we see that weakness that some people are saying might be required to get inflation to the point that markets are currently expecting?
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The word from pretty much all the Wall Street banks is they expect a better 2024, even though investment banking activity is about half the average level for the last decade. But, you know, we were in this spot a year ago saying, okay, deal's going to pick up, and it didn't. And it feels like we keep waiting and waiting and waiting.
Maybe it can't get much worse. That sort of seems to be the feeling on the street. Mike Mayo there of Wells Fargo weighing in on what has been the worst year in deal making in decades. Mergers and acquisitions down roughly 25% in 2023 from a year ago. The slump leaving bankers confronting a bleak bonus season and more job cuts if business doesn't pick up in the new year. It is likely to, though, and that seems to be what we're seeing right now with some of the deals being proposed and floated as we get headlines on the terminal. Joining us right now, I'm so pleased to say, Frank Aquila a senior M&A partner at Sullivan & Cromwell, here on set. So what makes you optimistic, Frank, that we are going to get some sort of resurgence? And I know you can't speak directly to the Paramount and Warner Brothers deal, but some kind of resurgence in M&A at a time where people can't borrow as easily on overly indebted structures.
Well, they can borrow. The issue is at what cost. And to the extent that interest rates were going up and you didn't know where the top was, a lot of boards and CEOs were not prepared to make the leap. But now that you say, okay, this is the top, it's likely to go down, maybe 3 cuts next year. I think you're going to see a lot of companies, many of which have plenty of cash on their balance sheet. So, they're not borrowing all that much. They're going to go back into the market.
Which areas do you think are going to be most active? Is it going to be the year where finally we see the tie-ups in the media space really the dominant story, or is it going to be across the board?
I think it's going to be more across the board in terms of both geographies. I think it's going to be more widespread, not just the U.S. I think it's also going to be a lot of sectors. The sectors I would look at is obviously media consolidation, but the energy and natural materials sector and healthcare. Even in the worst of times, you see big healthcare transactions happening, and with so many pharmaceuticals coming off of patent and going generic, the big pharmaceutical companies have to constantly refill their pipeline. Their R&D pipeline is limited, so they have to go out and acquire these smaller companies. And that's what you just saw with Pfizer acquiring Seagen.
Mm-hmm. And of course, a lot to keep an eye on there from an industry perspective. But you mentioned, though, that it's not going to be just the U.S. So let's talk about global deal-making volume. Of course, as Lisa said, you take a look across the globe, falling under the $3 trillion mark for the first time since 2013. And the reason we keep hearing is that there was just a lot of uncertainty in the world in 2023. But then you take a look at 2021, when there was also quite a lot of uncertainty, and global deal volume came in at $5.3 trillion. What's the difference between the uncertainty that we saw in 2021 and 2023? Is it just interest rates?
It's really three factors in my view. One is the interest rates. And again, not knowing how high interest rates were going to go. Second was the fact that there's so much regulatory scrutiny. And the thing we're seeing is that deals are getting done. It's just taking a lot longer. So CEOs and boards want to factor that in. The third thing is global conflicts. I mean, the two biggest, obviously, Ukraine and Gaza. But there are other conflicts around the world, all of which I think depress the need and the interest in doing further consolidation. But to some extent, those are factored in now, and with interest rates at least stable and probably going down, I think we're going to see more deals in a number of sectors and a number of geographies.
And of course, you have a unique perspective on this next question, actually being in some of these rooms. But given the antitrust environment that we've seen under the FTC, how it feels like the FTC has been winning, but it's also been losing some of its antitrust cases, how are potential merger combinations? How's that conversation evolved? Is it more likely that maybe you'll just go for it, take your chances, versus we're only going to do this if we're sure we can get this through?
Right. I think 18 months ago, a lot of CEOs and boards were saying, we don't want to do this unless we know we can do it and we can do it quickly. Now, as people have gone through this and have seen that, whether it's Pfizer Seagen or Microsoft Activision, that it's going to take longer, they just factor that in. And so they'll go forward knowing that they might have to litigate, but with a sense that in most cases they're going to prevail. Not in every case, but in most cases they've prevailed. And while the FTC would like to change the antitrust laws haven't changed, and the federal courts have been pretty good at pushing back on them.
Is there a new sense of urgency right now to merge, just given the fact that what we've seen over the past couple of years is that bigger businesses have done better? The economies of scale have allowed them to survive and be more resilient, and they've gotten bigger and, frankly, been rewarded much more in the stock market.
I think that's the case, and you're hitting on a very good point. With new technologies, AI, generative AI, that's going to take a lot of investment for companies. And small competitors are going to have a hard time doing that level of investment. In the 90s and the early 2000s, we saw a lot of bank consolidations because they needed to put in a lot of new technology and infrastructure, and it was only the bigger banks that really could afford that. So I think we're going to see a lot of industries looking to invest in technology, and that's going to be expensive.
I can't help it. I have to ask you this question because I do have lawyers in my family and who are close friends, but there is this big debate about whether ChatGPT is going to take away some of the very long hours of associates that have to go through all of the documents on deals, and whether that could potentially make it a more livable experience, and the bigger law firms will be able to do that in a more significant way. And if that's sort of the path forward for a lot of the legal professions, do you see that actually happening?
Well, we've seen that to a certain extent in litigation, and I'm not a litigator, but in terms of document review and whatever, technology makes it easier. And, you know, the reality is clients don't pay us significant fees because of drudge work. They want the creativity, they want the expertise, and the more you can devote your attention to dealing with issues, dealing with problems, advising them, the better it's going to be. And it's a better existence, as you say, for particularly the younger lawyers that don't have to spend 16 hours a day with, you know, not very interesting work.
Just to totally shift gears here, have you heard of hipster antitrust?
Yes.
I'm a little obsessed with it at the moment. Do you think that that's actually a new way of thinking, a new approach that will stick?
It might be. I'm not convinced yet. I'll put it that way.
All right.
I do like that, this idea that there's some sort of philosophy. Just real quick, though, I do want to get your sense, before we let you go, of what you think, what industry you think will have the biggest deals this year, given the fact that it does seem like we have to get more activity than we got this past year.
I think number one is going to be energy. I think that's where we're going to see the consolidation. You know, oil prices are down because the long-term outlook isn't that good. So the big companies need to consolidate.
And we've already seen that to some degree. Thank you so much for being with us.
Good to see you.
Frank Aquila of Sullivan and Cromwell with us on studio. And we did get a number of deals, including another deal that we didn't mention, just crossing, that Blue Origin and Cerberus are bidding to buy the United Launch Alliance. This is basically the conglomerate of different billionaire space opportunities, I believe. So opportunities maybe in the space consolidation space.
Yeah, I don't know how much more opportunity for consolidation there is there, but interesting to see that it felt like very much like bull market behavior when we had all these billionaires launching their rockets into like suborbital space. I missed that time.
In fairness, some of the SpaceX exploration and the satellites, Starlink has been a raging success and has led to a lot of dominance when it comes to the satellite system, and we're talking about the potential IPO of that coming up as well. I'm sure a lot of bankers are looking forward to a more active year after what the weakest volume of M&A going back to 2013. Coming up next, we are going to be speaking with Peter Scheer of Academy Securities to understand what happened yesterday after 2:30 p.m., but also the road ahead in a year that is going to be pocked with uncertainty, pocked with political disruption, and pocked with geopolitical risk. Right now in markets, you are not seeing that geopolitical risk or political pressure or other uncertainty anywhere in sight, up about 0.5%. 47.74 crude, lower after that news on Angola. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI,
you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
With the Fed taking its foot off the brake, there's the risk that inflation reemerges at some point.
When I think about the next year or two, I don't really see any meaningful catalyst to sort of break us out of what could be a really sluggish growth backdrop.
We may ultimately get a mild slowdown or a mild recession, which would be characterized as a soft landing. But I think it's a really dangerous landing at this point.
We don't need the consumer to be in a recession for the U.S. economy to be in a recession.
Those savings have been whittled away. We do think we ultimately end up having a mild recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Here come initial jobless claims as everyone starts to wonder, okay, is the labor market really all that strong? From New York City for our audience worldwide, good morning. Welcome back. This is Bloomberg Surveillance live on Bloomberg TV and radio. Tom and John are both off on a well-deserved break into the new year. I am so lucky to be alongside Katie Greifeld this morning. As we get you through the day, we are about 30 minutes away from initial jobless claims. That, to me, is key at a point where so many people are hinging their bets on a soft landing.
Oh, big time. Again, when consensus is so one-sided, when the market is so one-sided, maybe we got a 1% move lower yesterday, it feels like every single data point takes on more importance, and especially when you think about how thin liquidity is right now, could definitely leave a dent in some of these charts.
Which is the reason why people are so focused on what happened yesterday at 2:30 p.m. when all of a sudden stocks fell off a cliff to have their worst daily loss going back to September at a time where there wasn't a clear catalyst. Yes, you heard Patrick Harker talk about the need to cut rates in light of some possible headwinds that he sees coming down the pike. But is it that? Is it a delayed reaction to FedEx, which is what we were hearing from, was that Stuart Kaiser?
Yes, it was.
So at what point are we seeing some kind of disruptions under the surface that give some people agita?
And I will say it's interesting to see how broad-based it was. Of course, you've been bringing up that point that it was broad-based on the way up, broad-based on the way down. But overall, it feels like the fact that you have seen this rally broaden out over the past 2 months. It's not just those top 7 names dragging the index higher. That's been a rallying cry of the bulls, saying that this one has momentum.
Which is the reason why I'm so focused on some of the earnings that we've been getting. Yesterday, we heard from FedEx. They gave a weaker than expected forecast on volumes. People aren't sending as much. And they aren't able to charge as much on the express offering. You also heard from General Mills. I guess Lucky Charm sales are down. So there's a question around the appetite of people there. Today we get Nike. How much are the corporate earnings going to express the same kind of euphoria that we've been seeing in the stock action?
I will say everything about this economic cycle, about this market cycle has been strange. And I was checking out some of the sector performance year to date yesterday. Consumer staples are lower on the year. You think about how much of the conversation has been dominated by inflation, by these conscious consumers, resilient, but really conscious of how high prices are right now. And yet, consumer staples, you would think it would be a winner, not this year.
Prices, meanwhile, are rising this morning across the board for equities. We can see the S&P up about 0.5% right now as we head toward the open, 47.73 on the S&P. You can see yields just marginally up, but definitely the bid coming into the bond market as time goes on. 3.86% now on the 10-year, solidly below 390. Thinking about some of the peaks that we saw in late October of nearly 5% on a closing basis. Just shocking to see more than 1% of a decline, a percentage point of a decline on that 10-year yield. And crude, I want to just note this, that we did see that sell-off accelerate after news that Angola was planning to exit from OPEC amid that spat over oil quotas, this according to the local newspaper there. But we have more reporting on this, and we are seeing a response in markets as people anticipate more supply coming to the fore. We were talking earlier this week that the Fed shot all the bears, not all of them. One of them still remains, or a number of them maybe, and Peter Shear, head of macro strategy at Academy Securities, who hasn't been bearish, but maybe is starting to get a little bit more so. You recently are starting to feel a little bit more negative. Why?
You know, post-Fed, I thought, okay, this can run a little bit longer. I haven't liked how the market's traded very much. It's, you know, you've continued to have this rally in the Russell 2000, the small caps, CRE, small banks. It's been a phenomenal rally. Russell 2000's up 17.5%, 18% since November 7th, and yet everyone still wants to talk about Magnificent 7. And NASDAQ 100 has not done much since early December. I think it's up 2%. And the way things have traded, I don't like. I think yesterday was a precursor that instead of buying the dip, I think you're supposed to sell into this. I think we're going to feel a little bit pressure on the big caps coming into the new year.
And do you think that this is going to come from people who are worried about recession? Do you think this is going to be technical? Do you think that there's just some sort of pressured selling that is overwhelming any of the narratives that people are trying to come up with on the back end of them?
You know, I think, as you said, all the bears got shot, so that money got forced in the market. People are already long anticipating, you know, the year-end flows you're going to get, the early year flows you get as RIAs start funding. And I think that's just overdone, and people got too excited. And the one big problem with these large caps is if there is selling pressure, the market caps are so large, it's very difficult to absorb them. And one thing that really triggered me is probably overnight, I kept reading how yesterday everyone wants to blame zero-date expiration options for why we sold off from 2 to 4. If you go back 3 of the last 4 days, from 2 to 4, we had these weird spikes, which were probably largely due to zero-date expiration options. So when people highlight something as a culprit, it tells me everyone's kind of long and is looking for an excuse of why they were wrong yesterday. And that's why I think there's more staying power to selling pressure right now.
Well, Peter, just to draw a line under the point you're making, are zero-day options just a convenient excuse at this point, or is this something that maybe we should be worried about?
I think there's something that's there every single day. I think, as always, when people are bullish, they're going to ignore why things might have happened. So I think they ignored the pressure that zero-day expiration options put. And the one thing that I talked to a lot of clients about is, for a while we had this weekly option trade, right? People would come in on Monday mornings, buy Qs, they'd buy individual stocks on the option side, then they'd pressure it all week and it would rally into Friday. You know, the ape stocks benefited from that. But that was really a long-only type trade. It was difficult to do that from a put side. I think on the zero-day to expiration options, it's just as easy to push things lower as higher, and that's what people forgot, and I think that's what we're looking at right now. It happened a lot prior year. It's starting to happen again.
You know, I haven't heard ape stocks in a while. That's a nice blast from the past. Let's talk about the spiritual opposite of some of those meme stocks. Let's talk about the bond market and what is going on at the long end of the curve, because I understand what's happening at the front end with 2-year yields. I mean, really just a proxy for monetary policy expectations. But like Lisa mentioned, you think about 10-year yields a percentage point lower than where they were in October. What is being priced into the long end of the Treasury curve right now?
You know, I think fear of missing out almost. First you had the squeeze, people are short, but I think right now people are like, well, I can buy my 5% 2-year or whatever it is and make some money, but what happens if yields go all the way back down? Is this my one and only chance to own the 10-year at 4%? And you've seen that in the muni sector. I like closed-end funds in the munis as a really good indicator of retail appetite, and you're seeing discount to NAVs really shrink. So I think people are saying, wow, what if we go back to sub 3% on the 10s? I better buy some yield right now. So it's been a duration grab. I think it's misplaced. That's what's going on. And so again, it's something I want to start fighting. I think we should be back above 4% on 10s. It's going to take a little bit of while, but you really see, I think it's FOMO, like what happens if we are back to 3%? Will I smack my head and say, I missed that one chance to own at 4%, assuming you already missed the chance to own at 5%?
So you're leaning against this. Why? Is this basically a fear of reigniting inflation on the heels of more accommodative financial conditions? Or is this because of supply chain disruptions and other potentially inflationary catalysts?
Yeah, I think the inflation argument is still somewhat there. Again, I fought against inflation. I was on the deflation camp all last year. Now people seem to have gotten a little bit too comfortable that inflation's gone. I'm worried about what's going on with the supply chains. The Panama Canal is an issue. Now you've got the Middle East and the Suez Canal is potentially an issue. So I think you're going to see some upward pressure on that. And then I really fought back on the argument about 2 months ago about Treasury supply and the cost to the government of higher yields. And I said, that's not a today type event. Those things take a long time to play out. And that's one reason I got very comfortable being bullish at 5%. But these things are happening. And just because we went from 5% to 4%, it doesn't change the trajectory of how big of a part of their deficit debt spending is going to be, maintaining interest payments. So those are real issues. I think people will get back to focusing on that. DC will probably somehow do a good job reminding us of those issues, and that'll push us back to that 410, 420 level.
Such optimism that they'll be able to remind us comfortably of all of those issues. Once again, Pete, I am curious. You say that you are leaning against both the bond and the stock rally. How much so? Is this going to be sort of a top blow-off that people are expecting to start the year that then will be a buyable dip, or is it something deeper?
I think it's more that. It's going to be, you want to be cautious here, maybe take advantage. I don't see much more than a 5% drop because I do think the Fed put is fairly back. And I am looking for things to own. I actually really want to own energy stocks. I think they've been one of the underperformers. I don't love oil itself, but I think energy stocks are playing. It was really encouraging when your last guest picked that as being his probably top candidate for M&A activity. So I think that's where I want to be leaning heavily. I've liked the laggards for a while. I'm less enthusiastic right now about the banking side of things. I'm less enthusiastic about Russell 2000 as a whole. I do like the energy, and I still like commercial real estate, to be honest.
Wow. Okay. So some really brave, interesting predictions there. I will say when it comes to energy, really interesting sector. It's down 4% this year, of course, following 2 years of double-digit gains. But just to meditate a little bit longer on what's going on in the bond space, you mentioned that this grab for duration is a little bit misplaced. Are you more comfortable with credit risk or duration risk at this juncture?
I'm very comfortable with credit risk. I think at the investment grade side of things, there's an ongoing thesis that I have is that people are going to overweight investment grade credit versus treasuries. I think you're getting much better signals from a lot of these U.S. companies. They did such a good job of issuing long dated debt. And then at the other end of the spectrum, I think people have been so bearish on the CCC, single B minus sector, especially in the leveraged loan, that there's money that's going to start coming into the market. I think there's a lot of money got issued or allocated to distressed investors. Those distressed opportunities aren't coming up. So if they have to chase that market, I think you kind of get this really nice squeeze on credit. You get the bottom end going better. You get the high quality doing well. If you see the CLO market return, more robustly, which I think there's signs that that's going to happen, that will help credit. So I actually like credit risk better than duration risk.
Peter Scher, thank you so much for being with us. Have a wonderful New Year. Merry Christmas. Happy holidays. Peter Scher there of Academy Securities. If you are just joining the program, we do see a lift across the board as people retrace from yesterday's loss. We saw the worst loss going back to September, and it was broad-based. Today, we're seeing broad-based gains, 47.74. The S&P up 0.5%. I do want to just follow up on the story about Angola leaving OPEC. You asked the question, Katie, was this the first OPEC country in a long time to leave? Ellen Wald, a friend of this program, puts out on Twitter, not a huge surprise given how it's been going for Angola. Remember, Indonesia left OPEC in 2017, right after the formation of OPEC+, and Qatar left a year or so after that. So it's not unprecedented in terms of just the absolute exit. You are seeing crude continuing the decline, down 1.7% on the NYMEX, Brent down 1.6%, $78.44. Reportedly, Angola is leaving OPEC following 16 years of membership over a dispute over production quotas, so having to do with needing to or wanting to produce more.
And it's interesting, with Angola finally leaving here, or announcing that they're going to leave, now membership in OPEC will shrink to about 12 nations. And like you said, this has been a really tense time for OPEC, trying to figure out where they want production to be, what they want it to look like. Of course, as crude seems to only respond to supply right now, and we know that demand hasn't exactly been there, maybe in the way that it was expected coming into 2023.
And demand from where?
Yeah.
Right? Is it demand from China because the U.S. is supplying itself with so much oil that it doesn't even need any of the oil from overseas, right? So then the bulk of the imports from the OPEC Plus nation will be from China. We're going to keep an eye on this, especially given that oil has been one of the biggest surprises this year. Coming up at 8:30 a.m., we've got Steve Rasciuto of Mizuho Securities reacting to jobless claims. This just in from Andrew Hollenhorst over at Citi, talking about Patrick Harker's dovish pushback. Harker's comments, he wrote, help confirm that Fed officials are anxious to cut as they're increasingly worried the economy will enter recession. From New York, this is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think the notion that Xi Jinping is determined to pursue reunification with Taiwan is not new. Beijing continues to exercise what you could call strategic patience on this issue, and that's important because if that changes, it does, I think, increase the near-term risks around Taiwan. For now, I think those near-term risks are manageable.
That was Michael Herson of 22V Research reacting to an NBC report. The Chinese President Xi Jinping told President Biden that China plans to reunify with Taiwan. Senator Lindsey Graham having some fiery words about that, commenting on the report, saying he would, quote, draft pre-invasion sanctions from hell to impose on China if they take action to seize Taiwan. We are hearing about potential sanctions on Chinese electric vehicles from this administration this morning. Joining us now, I'm so pleased to say, is Susan Thornton, Senior Fellow at the Paul Tsai China Center at Yale. Susan, I just want to get your sense of how much of a sort of increase in a threat the NBC report on what Xi Jinping told President Biden really was.
Yeah, thanks very much. I think this is really a tempest in a teapot. The things that Xi Jinping said on Taiwan in the meeting with Biden are absolutely not new. The Chinese have repeated at almost every occasion that Taiwan will be reunified at some point. So I don't think anything that the Chinese would have said on this issue would be considered new by people who watch this issue. Maybe by people who don't watch this issue, they would have been surprised. But I do think the Chinese are kind of reflecting some concern that U.S. policy is shifting toward a support for a kind of permanent separation with Taiwan, and that would be maybe something that would be causing them a little bit of alarm and may have added some oomph to this kind of statement about Taiwan will be reunified.
They added a lot of oomph this morning when you talk about the potential prohibition of exports of certain rare earth metals that are really crucial in a lot of electric vehicles. And this comes as there are reports that the administration in the United States is thinking about possibly increasing the tariffs on imports of certain goods having to do with electric vehicles from China. Is this a really material increase in the tit for tat, the trade war that we saw really heat up a couple of years ago with China and the U.S.?
Well, the Chinese have already announced in a couple of other occasions some selected restrictions on exports of rare earths, trying to show that they have cards that they can play too in this tit for tat trade war. I think what we're seeing from the Biden administration is a desire to kind of adjust some of the tariffs that the Trump administration had imposed on China and which the Biden administration left on. So, EVs are a particular concern because of the desire to try to ramp up manufacturing here in the U.S. Of course, they're also a big concern in Europe. And so I think that's what we're looking at. Certainly, this is a hugely successful sector for China, so they don't want to see this tariff imposition happen. I think probably they're resigned to it at this point, and this is probably just a lot more signaling than something that's unexpected.
So resigned to tariffs, but what about when it comes to sanctions? I mean, to go back to what Senator Lindsey Graham said, saying that he is intent on drafting pre-invasion sanctions from hell to impose on China if they take action to seize Taiwan. How would those sanctions be received, and would that actually deter China in any fashion?
Yeah, I think it's really important that we sort of try to separate the Taiwan issues from the trade war issues because they are very different, and people have, a tendency to try to lump all these things together, especially up on Capitol Hill. The issues around trying to draft, pre-invasion sanctions have been talked about up on Capitol Hill for a while. It didn't work with Russia, and those sanctions were probably much more dramatic than anything that could be imposed on China in terms of trying to get the rest of the countries in the world to go along with it. Of course, the sanctions regime only works to the extent that you can get other countries to also join in. So I think this is an effort by, people to try to show the Chinese that we really don't want them to do this. But again, the summit was very successful, the summit in San Francisco between President Biden and President Xi in trying to tamp down this issue. And it seems now like there's a desire in some quarters to try to ramp it up again. And I think that's unfortunate. I mean, we really do need to see some stability on this issue going into what's going to be a pretty tumultuous year in U.S.-China relations, I think.
Well, Susan, to that point, of course, the APEC summit, it was perceived as going well, and I think that's why part of the reason why there was surprise to see this report from NBC yesterday when it comes to China's intentions with Taiwan. But, I mean, you made the great point that this isn't necessarily new rhetoric from China when it comes to Taiwan.
Absolutely. I think the summit actually on Taiwan, my understanding is the two leaders didn't really spend a lot of time on that issue, and that there was a tacit agreement to try to work to manage this difficult issue. You know, we have the Taiwan election coming up on January 13th. That's going to pose, you know, tensions and some difficulties in the relationship. There'll be an inauguration in May, and there's always a lot of back and forth between the U.S. and China on how these issues will be handled. And I think what we were trying to get from the summit was that these issues will be handled, you know, carefully. And that was the message that was trying to be conveyed. And now we've sort of got back to this increased sort of hype around a possible military action, which I agree with Michael Herson, I don't think is imminent.
Given the fact that we are dealing with a very political year heading into the election at the end of the year, how can there be any kind of diplomatic discussions between China and the U.S. with any conviction if it is not clear who is going to be in the White House come 2025?
Well, this is an issue for diplomats working on relationships with pretty much every country in the world right now. I mean, all countries are kind of looking at our political situation and wondering what's going to happen and wondering what kind of commitments they can make with us in the coming year. So it is difficult and you know, probably especially difficult with China. The only thing I would say about the U.S.-China relationship is that it's less likely probably to turn on a dime with the you know, accession of a Republican president, be it Trump or anybody else, because I think there is this kind of bipartisan approach to China, which is quite, you know, hawkish at the moment and probably won't change no matter who comes into the White House. And I think the Chinese do know that. So they are looking at, you know, the coming year and then the years after at sort of how to manage what's going to be a pretty difficult time, I think.
Well, Susan, you bring up a question that I think about all the time when it comes to U.S.-China relations. A lot of these issues go back years and years. They outlast any one administration. And like you mentioned, being hawkish on China is very bipartisan at the moment. And with that in mind, how much does it truly matter? How consequential is it who is actually in the Oval Office?
Yeah, well, you mentioned that being hawkish on China is bipartisan now. I mean, I think it actually goes a long way back, and almost every issue we have today with China has been around for decades, you know, especially on Taiwan. If you go back and look at, I've been looking at historical records lately from the Carter administration, and you know, every single issue was talked about at the time of normalization between the U.S. and China in 1979. So we're 45 years on from that, and I think it, you know, it's just going to be two big countries, huge economies, important players in the world, and it's just going to be so difficult to figure out how to manage all of these issues. I think the most important thing is that whoever's in the White House should be expressing confidence about the future of the United States and our ability to be resilient and, you know, maintain our competitive edge. I think that's the most important thing.
Susan Thornton of the Paul Tsai China Center at Yale University, thank you so much for being with us. We have been hearing a lot of the tit for tat, and one person after the other says this is just basically showcasing the already there tensions that have been in place for a long time.
And I can't decide if it's comforting. I mean, to go back to that question of how much does it matter who is in the Oval Office? I mean, a lot of these issues, they outlast any one president. You think about how bipartisan it is, the approach to China. It's going to be a very interesting presidential election cycle. But again, a lot of this is outlasting them.
We are about 4 minutes now away from a key initial jobless claims, the resilience of the U.S. economy for front and focus. As we take a look at whether the labor market continues to hang in there, certainly equities do. We could see the lift maintaining up 48 basis points, 47.72, yields just marginally higher. You could see oil declining on the prices of Angola.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Just seconds away from the key economic data of the day. We get initial jobless claims in just a moment, setting up the market action. You can see a lift ahead of that as people retrace, rethink. Maybe this is a buy the dip moment. Yesterday was a dip. You buy it, 47.72, up about 0.5%. Yields just marginally higher, 3.85%. What I'm looking for here is a sense of initial jobless claims coming in with the expectation of 215,000. They do come in. They are below expectations. Once again, 205,000 jobless claims. That is up marginally from the month before, which was 202,000. That is the unrevised number. We have not yet gotten the revision. We also get a slew of data. This is the third revision of third quarter GDP, and so that came in actually a little bit lower than expected. The survey called for 5.2% in terms of third quarter growth. The actual is 4.9%. Across the board, though, not much change on some of the individual components. You're not seeing a tremendous reaction in markets, although S&P futures continue their lift, and you can see that pretty much across the board. NASDAQ futures up about 0.7%. The Russell pairing some of the earlier gains up 0.9%. Really edifying, though, Katie, this idea that the economy is strong. We're not seeing things crack. You're not seeing a sort of a slew of people filing for initial jobless claims at a time when the economy is still doing quite well.
That's the thing. I mean, the labor market has just been Teflon strong, and you can see it's sort of percolating through the markets right now. The line's deciding where they want to go, but we keep talking about the resilient consumer and the resilient labor market, and it doesn't seem like any of that is really budging as we head into 2024.
That said, and this is interesting to me, especially in light of what we heard from Patrick Harker of the Philadelphia Federal Reserve. The Philadelphia Fed business outlook came out lower than expected, declining 10.5 versus the expectation of the decline of 0.3. So to me, how much is this? Maybe something that different sectors are seeing. Patrick Harker pointing to some of that weakness as part of the reason why he's opting to cut rates next year.
Well, that's the thing. It feels like you can paint the entire economy with the same brush, that there are pockets of weakness, and then there's pockets of strength. And one of the conversations that I had a lot in 2023 is whether we should be talking about a rolling recession. Maybe we don't see it on a broad economy-wide level, but we have to look to specific industries, specific sectors to actually see the effect of those higher rates.
And we're going to have the broad economic conversation in just a moment, but to talk about the specific sectors and some of the rolling recessions. One of the recessions has been in the logistics area and the shipping area. And I do, before we get to Steve Rasciuto of Mizuho here, I do want to just touch base with Lee Klaskow, Senior Logistics Analyst at Bloomberg Intelligence. And Lee, the reason why you're really the person who I want to speak to is to understand how much we could be dealing with potential supply chain disruptions again because of what we're seeing in the Red Sea.
Yeah, I don't think these are going to be a major dislocation. I think it's going to be more or less a hiccup, if you will. But the net effect is that freight rates are rising. They're actually up about 9% sequentially. A lot of that increase is being driven by freight headed from China to Europe. That's been up pretty significantly, up around 15-16% over the last week, and it's up around 50% since bottoming in October. But it also just need to remind people that in 2021, to ship a container used to cost $14,000. That was a peak. Today it's around $1,400. So rates are down significantly, but we are seeing a bounce. And what's going on in the Red Sea, I'm guessing that it's not going to be long-term in nature, and there's going to be a resolution in the coming months.
And Lee, with that in mind, just quickly here, if you anticipate a resolution coming in fairly short order, does this ever touch the consumer, if at all?
Absolutely, because if shippers are paying higher rates, they're going to try to push that cost onto the consumer. But remember, there's a lot of T-shirts that go into a container, so we're talking about a half a penny more in terms of shipping costs to ship certain items. Obviously, larger items, the impact's greater, but a lot of stuff that goes on the ocean are usually lower value stuff, where high value stuff is usually shipped via air freight.
Lee Glasgow of Bloomberg Intelligence, thank you so much for being with us. Short a visit, I do want to get to the economic data that we just got, since it is fascinating to me. Steve Rasciuto here with us, chief economist at Mizuho Securities. And I want to start there. Initial jobless claims came in below expectations. It's actually a positive downside surprise. And yet you're seeing a real rally in the 2-year, which makes me think that the Philadelphia outlook for manufacturing is of concern. Is that right?
Well, I think you have this environment where you have people like you mentioned, Harker, talking about, the grassroots kind of sentiment that they're getting in terms of information from companies that tell them that there's a problem in the underlying economic fabric, but you're not seeing it in the broader macro perspective. I think this gets to what was Kitty was talking about in terms of rolling sector recessions, but I think it also gets to the fact that expectations are really an issue, because when I sit down and I talk to CFOs and I talk to CEOs of different companies in different industries, I get the same message over and over again, which is, the economy's not going to do well. We're going to go into a recession, but my business is doing really well. And I kind of like, time out, guys. Everybody tells me exactly the same thing. So if you're all telling me your business is doing well, but you all think the world isn't going to do well, then maybe you've got a disconnect in terms of the underlying realities. And this is why you see the continuing claims numbers doing what they're doing. They're moving lower. So you also see this in terms of the employment numbers. Everyone says, oh, we're laying off workers. But then you go back and look at their actual job counts, and you see that they've repositioned their workers into different parts of their business.
So put this together. Help us understand what's actually going on. Is this basically people are feeling bad because they feel like they should feel bad, and that actually things are very good, and that the risk is actually to an acceleration in the economy that people aren't expecting?
Well, I think the risk is the recession that the market is expecting doesn't happen. You look at things like the blue chip average, right? The blue chip average has first half growth at 0.5%. Now, 0.5% is the closest you're going to get the blue chip numbers to ever saying negative GDP before you actually print negative GDP. So recession is priced into the structure. If you don't get recession, you're going to have a readjustment. This is exactly what happened after the regional bank situation. Remember, everyone forecasted a recession. It didn't happen. Then we had that major summer sell-off. I'm not saying we're going to get as much of a summer sell-off as we got this time through, but there certainly needs to be a correction in some of these markets to reflect the fact that this economy is not rolling over and playing dead, that expectations are different than the reality, and eventually expectations have to adjust to reality, because reality is what it is. It's the reality.
Well, just to meditate a little bit on the evolution of the recession calls. Remember, 2023 was definitely going to happen, and then everyone started pushing out the recession calls and then basically abandoning them altogether. There's actually a story on the terminal right now. Citigroup, Deutsche Bank, Wells Fargo, some of the last remaining on the street who are still calling for a recession. But just to that idea that maybe rolling recessions are what we're seeing at the sector level, is that the way we should be thinking about this economy, or are we smooth sailing from here?
I think the economy is fundamentally healthy. I think we've discovered that, the Fed is uncomfortable with a 5% 10-year note. I think the Fed is somewhat equally uncomfortable with a 10-year note moving below 4% the way it is. But you have to keep in mind the fair value trading range on the 10-year note, if you assume a 2% target is basically 3 3/4 to 4 1/4. We're in the bottom half of that range, and no one's going to be selling this market going into the end of the year. There is zero sellers out there, and the bulls are still in favor. So what you're seeing happening on a day like today, where the claims numbers come in lower, continuing claims come in lower, the GDP number probably went down. I don't have the details, but I'm assuming because of inventory.
Yep.
Okay, so those are things that tell you better growth going forward. And then we latch on to the one thing here that we can say, oh, gee, it's time to be bullish again. We'll push, and I think by the end of the day, we'll realize it wasn't worth pushing.
So should we be just applauding the Fed right now? Because you think about what we've seen so far. We've seen inflation come down from once-in-a-generation highs. The unemployment rate is still under 4%. And, I mean, everyone seems to be left and right abandoning their recession calls. Is it safe to say that the plane has just about landed here, that they actually have pulled it off?
Well, the plane was never going to go have a recession. We were never going to have a hard landing. The only way you could have gotten a hard landing is if the equity market corrected to earnings numbers, and then you had companies being forced to really lay off workers to drive up margins. That never happened because the Fed kept on telling you we're going to cut rates. So because the Fed kept on telling you we're going to cut rates, you never had that adjustment take place. So the adjustment in terms of the macroeconomic story is clearly why the Fed did do that through forward guidance. In terms of whether or not they're going to achieve the inflation numbers, that's still open. We're looking at inflation numbers that are closer to 3% than 2%. Now, under average inflation targeting, and given the concept of this Fed in terms of the inflation concept, not wanting to get back to the zero bound at any particular point in time in the future, they're willing to accept 3%. The problem is at 3%, the 10-year note is much too expensive. And if the 10-year note's much too expensive, then the equity market's much too expensive. So the reality is the Fed may get us to a hotter landing, but the markets have to adjust to that, and they haven't.
That's the reason why I was just going to ask you, why are you bearish if you see the economy doing better than expected and no recession? Is this because you do think that there is this inflationary underlying pressure that people are discounting and that there's going to be a meaningful sell-off in bonds as people understand that?
Well, you have to keep in mind there is a global deflationary force which is real incredible. By the same token, there is a domestic cyclical inflationary force that's real incredible. And it's been a battle between the two of them. Markets never took on board the 9% spike in inflation. We never took that on board. So the fact that we've come down to these levels, which are in the fair value range of 2 to 3%, 2%, we have to ask ourselves a question. Is it 2 or is it 3? This is the question we haven't answered yet. And that's the critical question, and that determines whether or not where you want to be in the bond market. And to me, it also suggests that if this Federal Reserve were to do something like take an insurance rate cut, because you hear that conversation all the time. You saw that in 2018, you saw that during the Greenspan soft landing in the mid-1990s. They took these insurance rate cuts. The question was at these particular times, in those particular times, was that inflation hadn't spiked and we didn't have the cyclical tightness that we have. Today we do. And in 2018, 2019, we had a disruption in financial markets. We have no disruption in financial markets. I think if the Fed were to take insurance rate cuts right now, the dollar would collapse. If the dollar would collapse, you then get into a situation where the global deflationary story no longer helps out the inflationary numbers because we've been importing global deflation. But if the dollar collapses, we no longer import global deflation. And at that point in time, goods prices no longer go down. If goods prices no longer go down, then service prices are fully reflected in inflation. And that becomes the rub for the Fed. That's why they're in this difficult balancing act of pushing back when things get too aggressive, and when things go too far the other way, they have to push the other way. They're trying to fine-tune this thing. And so far, they've been able to pull it off because the market gives them credibility. You have to ask yourself a question. How many times can you get that lucky?
Steve Risciuto, thank you so much. You'll have to come back on in the new year and tell us whether it's working or not. Steve Risciuto there of Mizuho, as we did get the numbers showing fewer jobless claims than expected, a more robust than expected labor market. Right now, if you are just joining the program, you do see a lift to a market, and it gets even more of a boost following what we saw out of the jobless claims. Yields are lower, and you can see that the S&P futures up 0.9%, up from about 0.5%. Right now, 10-year yields 3.83%, the lowest going back to, I believe, July, going back there.
Yeah, it's pretty amazing. And again, the question of how low can we go, how low should we be, is really at the forefront of the bond market right now. Closer to 380 than 390. Some interesting movement here after those jobless claims. I think you're right. I think it's more the Philly Fed business outlook that's driving things right now, of course, coming in much worse than expected.
Steve Risciuto said something really important that I think we have to sit on for a sec. And this is this idea that people are clinging to the negative, even though there's a lot of positive. The fact that you have initial jobless claims coming in below expectations, continuing claims coming in below expectations. If people are picking up on the Philadelphia Fed business outlook as a reason to sell and to really lean into bonds and to lean into stocks, it gives you a sense people are searching for the weakness that they expect can cool off the inflation without something more material.
Isn't that what bond traders are supposed to do? You know, the doom and gloom guys, they're supposed to find the negative. And take a look at the equity market, certainly finding the positive. S&P 500 futures currently up almost 1%. Again, what we were talking about, what happened at 2:30 yesterday, that sell-off, it seems like a distant memory.
To me, though, I'm just still wrapping my head around this. It's actually, to be pessimistic about the economy is to be optimistic about the market, because it means that you can actually cool down the inflation enough to then restart a cycle. If you don't get that kind of cooling, well, then are we talking about a very different inflationary regime over the long term, or do you just buy in wholesale into the transitory story? This, to me, is the big question heading into 2024. Right now, with a lift, S&P futures up 0.9%. Coming up, a conversation with Brad Rogoff of Barclays as we look to the credit outlook for next year. This is Bloomberg.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What really isn't clear is what the Fed's trying to do. They haven't had the impact which perhaps they wanted to have, but at this stage I still am not sure what impact they wanted. They clearly wanted a rally. Are they trying to fine-tune the extent of the rally that they wanted? Because this is now getting deep into markets and way outside what I think central bankers need to be doing.
That was Sunal Desai, fixed income CIO at Franklin Templeton, trying to push back a little bit on how far the market has gone, concerned about reinflation risk. Right now, markets are not worried about reinflation risk. They are very much risk on, retracing some of the losses from yesterday, maybe not ending on the first weekly loss in 8 weeks, as you were pointing out, Katie.
I think we're going to be okay.
I think we're going to be okay. 0.8% gain on the S&P, 47.88, leaning up toward those record highs. 10-year yields lower, though, on the day after being higher earlier, 3.83%. I quickly just want to mention two names that I'm watching. CarMax came out with their earnings, and they beat expectations, even though sales volumes were down because of used car pricing, how expensive they're able to resell them. And again, this goes to this question of deflation in certain areas that maybe isn't as deflationary as we previously had thought.
Yeah, and it's interesting. You wonder, how much pricing power is left, not just for CarMax, really, but across the economy. Lower volumes, that's been a trend across a lot of retail names, for example, but higher pricing still saving the day. I wonder how much juice is left in that story, though.
Consumer affordability remains the primary headwind, this according to one analyst. So the fact that they were able to sell them the cars at higher prices maybe dents that narrative just a little bit. And Micron shares gaining as a result of reporting better than expected earnings last night, up about 7.6%. I want to get right to our guest because to me, this is one of the key questions, especially given the fact that we just heard from Peter Scheer that everyone loves credit, him included, considering that a lot of companies termed out their debt. Things look pretty good. The economy is strong. Joining us now, Brad Rogoff, head of FICC, Fixed Income, Currencies and Commodities Research at Barclays. I want to start there. Who is bearish on credit right now?
It's the end of the year. I go around talking about our outlook to a lot of clients. It's really hard to find that person who's very bearish. Now, there are scenarios where credit can widen. And one thing, there's a lot of euphoria right now. You guys have been talking about that all morning, all week, et cetera. But if you kind of go back, and by the way, a lot of it's justified by the economic data. You guys were speaking about that as well. If we go back to 3Q earnings season, right, when we were in the thick of that, not everything was perfect, right? And what you are seeing is in an environment, now it's a little bit less of that environment with the moves we've had in rates recently, but an environment where rates have moved a lot higher, the cost of financing moves a lot higher. If a company misses earnings, the chance of some accidents do increase, right? And when we look at what happened, especially if you look at the high yield market, right, where the risk is obviously greater, and we look at the dispersion between how different bonds traded, throughout the first half of the year, it was actually pretty low, right? That's sensible that there's a macro narrative. If you look in 3Q earnings season, it actually increased quite a bit to a more normal type environment. And I think that shows you that not everything is perfect for every company, but I get the bullish narrative.
I mean, honestly, the fact that Citigroup is getting out of distressed debt trading makes me think that there just isn't enough distressed debt unless it's going to go to private credit, and that's basically where it's going to live. I mean, is that the story that we're looking at right now?
So the private credit phenomenon is very interesting, right? Because it does have these implications on what does it mean for, what I guess we would call the normal historical broadly syndicated loan market or high yield bond market. And it's leading to changes. Both of those markets, right, have actually shrunk this year, meaning the high yield market and the broadly syndicated loan market. Not a crazy amount, but they have shrunk. And private credit has taken some of that. But look, if we look at private credit and what does it mean in 2024, if you are an investor, say, in high yield bonds or leveraged loans, I mean, it's a positive because that is where a lot of the stressed things have gone. I think the estimates are probably over 20 billion of leveraged loans that were all short-term maturities, that were lower rated, were refinanced into the private credit market in 2023. A chunk of those would have definitely been defaults at some point over the next couple of years.
That's a really interesting point that basically the problem child's in the public market. Maybe they're heading over to the private market and we'll let those guys deal with that. And with that in mind, I mean, for so long this year, I've just been hearing that this is an up in quality world, that, you want to be in quality names when it comes to credit investing. You said that euphoria is justified. And with that in mind, is this a down in quality environment that we're going into? Are you feeling safe heading out the risk spectrum?
Yeah, as I said, some of that single name stuff I just mentioned where we see you miss earnings and you're really hit means I don't think you can categorically go that way. However, if we look at, like, say, the high grade market today and you look at where single A bonds are versus where triple B bonds are, those triple B bonds are extremely wide to single A bonds for sort of the level of risk in the market today. So I do think you have to go down in quality there. I think if you looked at the high yield market, probably more of a barbelled approach is appropriate there, because of the idiosyncrasies when you get to really risky high yield names. But you have to do some of that if you want to get some return going forward.
And Barclays is out with its 2024 look ahead. And the first line is that the rally into year end will limit performance from spreads in 2024. And we've been talking about how very tight spreads are. And against that backdrop, is 2024 going to be more about, just clipping coupons, enjoying those high yields versus actual spread compression?
I think so. We got this Christmas present of some extra return in 2023, but it does have to come from somewhere. And I think it comes from next year. And really, and look, there's always two components to returns when you're talking about fixed income and a spread product. You're talking about spreads and rates. And both of them have gone lower recently. And that's not traditionally, if you think back about the history of the fixed income markets, that's not necessarily traditionally how it goes. When both of those come lower, I think you probably wind up looking at, maybe even a slightly lower than coupon type return. Nothing dramatic, but slightly lower than coupon type return as we look at 2024.
Especially because of what we just heard from Steve Ricciuto. Are you concerned that because of the euphoria that we've been talking about, there is going to be a sort of second leg of inflation, that the Fed's going to actually see some of their verbiage work against them with a loosening in financial conditions leading to a stickier inflation that leads to higher yields? Is that something you're gaming out?
Not entirely. I think that higher yields is something we are thinking about. I don't think we think it's because we see another pickup of inflation. I think, do we not see inflation come down as quickly as some in the market are thinking? Yes. And then we look at the rates market today, and we don't really see any term premium in it with what we've seen in the last month. And by the way, if the economy is going to hold up better, that might mean the neutral rate should be higher. And as a result, there should be some term premium, actually. And so when you put that all together, I don't even think you need inflation to pick back up as much as not decelerate as quickly as some are forecasting. And then, rates don't come down. And once again, that's not a tailwind like we've had recently for returns in the market, and maybe even a tiny bit of a headwind.
I want to end where we began. As someone who has to come up with a year-ahead outlook, how much harder is it for you to do so when there is such a huge transformation going on in the credit market, with such a huge portion of it going to the private markets, and banks getting in on it, but a lot of it is a lot less visible than some of the public markets, the traditional mainstays and tea leaves of the rest of, frankly, all of markets?
It's definitely harder, but ultimately, when I'm coming up with an outlook for public markets, right, I still have the information on those securities, right? And as I said, when you factor in, and look, we come up with things like default forecasts that, for example, from what we talked about earlier, they might be a little bit too high. Everyone who does a default forecast, what do they base it on? Many factors, but one of them is almost always the senior loan officer survey, or the SLOOS, which no one really knew what that was until this year. Now everyone's obsessed with it, right, after March. Yes, exactly. But when you think about that, that's been a very, you can make a nice chart historically that shows that, it shows the default rates, and it seems to predict it quite well. But if, a lot of the financing in more difficult situations, as you guys were just saying, is moving to the private credit market, then there's going to be a breakdown a little bit in that correlation, right? Because it's not about bank lending only. So some of that stuff is really difficult. As I said, when we're thinking about returns, I actually think it's a positive, right? Because it's taking away a little bit of your downside.
Brad Rogoff, thank you so much for being with us. Have a wonderful holiday, and we'll see you in the new year in New York. Brad Rogoff of Barclays. If you are just joining us, we are seeing a lift to markets after better than expected economic data, 0.8% gain on the S&P, a little decline on the 10-year. Oil prices just almost 1.5% lower after Angola reportedly is leaving the OPEC union. Katie, this was fun.
This was fun.
Let's do it again tomorrow.
I'll see you then.
Yeah, thanks.
And in
this is really
about
good.
9 minutes or so.
Yeah, well, we'll see you too then, because this is what it is on a holiday. Coming up on the Open, Emily Rowland of JH Investments, Eric Knudsen of Neuberger Berman, and Monica Defend of the Amundi Institute. From New York, this is Bloomberg.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. From the world of politics.
We're not going to be relying
upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. A lift to the markets. Maybe we're going to get an 8th straight week of gains, the longest streak going back years. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, investors pile into rate cut bets. U.S.-China trade tensions reignite. And Warner Brothers and Paramount discuss a possible merger. We begin with the big issue. The buying frenzy runs out of gas, maybe.
In terms of the sell-off yesterday,
there was sort of some money saying maybe we want to book some profits here.
Markets taking a breather.
Having a little bit of consolidation.
Some consolidation, some profit taking. I think makes sense.
People, just locking in profits before the markets go completely dead.
Many people are just off the desk, going on holidays.
You've seen such an extraordinary rally.
This 7-week kind of rip-your-face-off rally.
The market got into a bit of a frenzy.
I would not read too much into the kind of short-term market volatility.
I don't think we should be reading very much into what's been happening. I think the market is going to return into the rest of the year and finish on a strong note. There's quite a lot of big questions as we move into next year about can we continue as we move into January in this optimistic frame.
I do think you have to be careful here.
Let's just enjoy this calm right now, because I think it's going to get a lot rockier and a lot less, a lot more uncertain into the future.
Joining us now to discuss Amundi's Monica Defend and Eric Knudsen of Neuberger Berman. Let's start there. This idea that there has been so much enthusiasm. Some people are trying to push back. They did push back yesterday for a hot second, and now today they're back in the buying mode. Monica, are you more in the buying mode or more in the selling mode?
Actually, we were already cautious, and we are going to hold the position we have. We have kind of a cautious outlook, and we are already positioned for it.
Eric, what about for you?
We're looking to use volatility to move from cash into assets where we think we're going to get a higher return over the next 12 months. So I don't know about buying at these levels, but there are certainly areas within the equity market that are appearing increasingly attractive when you consider that the Fed, to a certain extent, is taking out some of the risks of higher for longer.
So, Eric, were you buying yesterday? Is that sort of the dip that's buyable, or is it something that is more significant or prolonged?
Yeah, where we see opportunity, and I because I'm multi-asset, I get to look across kind of a spectrum of opportunities. We see opportunities in the short intermediate end of fixed income, where, for example, the 2-year Treasury at 4.32, we're pretty confident that yield's coming down, and we think cash yields are definitely coming down. So we're looking for where we can redeploy cash into, attractive areas across fixed income. In equities, we're looking down the capitalization spectrum away from the mega cap 7 and trying to build exposures in some of the areas that have been kind of, left alone or left for dead for a while, and that are better value. So that's where we're looking to buy on the margin.
Monica, what does it mean when you're cautious, when you say you're not necessarily playing as much and you don't necessarily buy into the same kind of optimism that we're hearing from Eric?
Well, having in mind that we believe the United States will enter a mild recession in the first half of next year, rather than having, strong top-down directional calls, we do prefer to stay in the relative space, having preference for regions such as, or countries such as the UK, Japan, because of their sectoral old valuation appeal. Definitely bond is back, so this is where we like to be positioned amid some more structural thematics related to the net zero transition, artificial intelligence, CapEx, if not obesity medicine. So we're kind of blending some more long-term thematics, nesting with the more tactical opportunities that might come up on the fixed income and on the FX space.
Eric, when you talk about the optimism for next year, there is this concern right now that the financial easing that we have seen will reignite some of the strength that could cause inflation to either stay pretty sticky or even reaccelerate. Are you concerned about that at all?
Absolutely.
Well, we think that
when you think about the Fed's pivot or change in language and direction, it really does take out one risk that they stay too high for too long. But and that is perhaps reason to justify some of the market movements we've seen. But it amplifies the potential for having to be a little bit more concerned about inflation. So while we don't think that inflation reinvigorating is our base case, we see kind of a continued move down in inflation, probably not to 2, but maybe the high 2s. We do want to ensure that our portfolios have some hedging, have some exposure that will do well if we do get surprise inflation. And I think that's also very important when you consider, some of the geopolitical risks that are out there, and being positioned, and that could be commodities and some real assets.
And we'll pick back up on that in a minute. Monica, do you want to weigh in there?
Well, on inflation, we think we are on track, but the journey won't be linear. And again, we don't expect to land to 2%, so to the central bank's targets by the end of 2024. We will need to wait more. And probably over the next 2 months, in particular in the euro area, we're going to see some uptick. And there is a substantial difference between the US and the euro area when it goes to wages dynamics, where probably something more might be piling up in the euro area.
All right. Meanwhile, U.S. futures are pointing to a rebound following a bout of selling yesterday that saw the S&P notch its worst decline in nearly 3 months. Bloomberg's Katie Greifeld joins us for more. It's been a long time, Katie. What's going on?
Well, I'll take you back to about 2:30 p.m. yesterday. Of course, we've been discussing this over the last 3 hours, though. But you think about what happened then. Stocks quickly and suddenly taking a leg lower, finishing the day around 1.5% lower. Like you mentioned, the worst one-day performance since September. And there was no real catalyst other than it's very late in the year, and we've come very, very far when it comes to this equity rally. But regardless of the reason, you take a look at whatever fears were percolating yesterday yesterday afternoon. They appear to be an afterthought this morning. The S&P currently up about 0.8% pre-market, those futures, and that's taking back about half of yesterday's loss and inching the benchmark ever closer to that record close of just over 4,800. And this could be really a preview of the type of market that we should expect in 2024, that buy the dip mentality really working its way back into the market psyche. I'll take you back to a Citigroup strategist note out this morning, certainly saying that that's the winning strategy. They wrote in a note that 19 of 24 industry groups right now are either at or near overbought readings. And as such, they write that the message is to expect pullbacks and to buy into them. And Lisa, you raised the great point of if everyone's buying the dip, are there going to be any dips left to buy? But that's a conversation for a different time.
Katie, I'm sure we'll be having it pretty soon. Thank you so much. So with us, Monica Defend and Eric Knudsen. Eric, I do want to pick up on your point about commodities, that you're leaning into them as a possible hedge for inflation. We are seeing oil prices not participating in the rally today. Lower on the news, Angola is going to exit OPEC over disputes about some of the production targets. How do you see this evolving, given that that's been a huge tailwind in the disinflation story this year?
Yeah, so we think on the margin commodity prices are likely to be rising from here, and there are a number of indicators to lead us to that conclusion. Pricing in the forward markets gives you a positive roll yield for owning commodities forward, which is generally an indicator of supply-demand imbalances and higher prices going forward. And that includes in the energy space where we've seen so much volatility and downward pressure this year. We also think that commodities will benefit from a lower interest rate environment and from the reduction of recession risk. We do think recession is still a risk. It's not our base case, a little different than Monica, but some of that risk is being taken out. And then finally, there are going to be a lot of geopolitical headlines in the coming year, whether it's elections or further issues or challenges around hotspots in the world, and commodities can help hedge against that. And lastly, one of the potential surprises, which could be positive in some ways, but inflationary in others, would be if China does stimulate significantly, and commodities can help hedge against that unexpected outcome as well. So they really are going to be, robust against a number of different environments and help portfolios from a diversification standpoint.
Monica, given your recession outlook, do you lean against that? Do you talk about the potential for increased weakness in the commodities sector that's already been under a lot of pressure?
Well, I think that because of our recessionary scenario, we do need commodities as an hedge. Think about gold, for example, also against all the geopolitical headwinds we might see. But more in general on commodities, as Eric was saying, the demand and supply dynamics are going to come into play when it goes to the net zero transition. This will create demand and support for certain commodities. So really, we think that the trend should be on an upward side.
At this point, when we take a look at the potential for increase in prices, I'm just wondering, Eric, do you think that that's going to be on strength, or do you think that that's going to be on supply chain disruptions? I mean, how do you sort of game out what's even going on, given the fact that demand is still at all-time highs for oil, and yet we're seeing prices go down as a result of U.S. production that's risen to record highs?
I mean, again, we have to look at what we can observe in markets, and forward spreads on in futures contracts would indicate that prices are going to be rising and that there are supply-demand imbalances, and those will be reflected in future prices. So that would give you one indication. And then we have to think about what other risks we can manage, and we don't have an edge in calling elections and calling geopolitical risks, or even how to position in front of geopolitical risks. And we also acknowledge that probably surprise inflation as a risk has increased, with the shift in Fed posture. And so we think that all of those make us want to own elements of the energy complex, industrial metals, and also precious metals.
Monica Defend, Eric Knudsen, both of you are sticking with us right now. Let's take a look at what's moving ahead of the opening bell as everyone buys every dip out there. Here's Abigail Doolittle. Abby.
And Lisa, we do have a number of stocks on our board that are helping give the market this lift this morning, starting off with the shares of Micron, heading to the best day right now, at least since April of this year. They put up a strong quarter. Importantly, they also boosted the forecast, strong forecast buoyed by data center demand. They're now looking at revenue for $5.1 billion to $5.5 billion for the fiscal second quarter. Investors really liking that. Boeing up 1.7%. China is said to have approved its first Boeing 787 delivery since 2021, suggesting an indication perhaps that the strained U.S.-China trade relations may be easing to some degree. And then Tesla up 1.9% after falling 4% yesterday. We do have a bit of a bounce back, as we can see by those futures for the big tech names in particular. Tesla was down more yesterday, up more today.
Abigail, thank you so much. Coming up, U.S.-China trade tensions heating up.
The Chinese have already announced in a couple of other occasions some selected restrictions on exports of rare earths, you know, trying to show that they have cards that they can play too in this tit-for-tat trade war.
That conversation still ahead as we bounce back from yesterday's one-day dip that everyone is buying. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long skinny necks. So Apatosaurus is an example. They also had really long skinny tails. So I made a computer model that showed that in fact the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate wild card. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
The Chinese have already announced in a couple of other occasions some selected restrictions on exports of rare earths, you know, trying to show that they have cards that they can play too in this tit-for-tat trade war. I think what we're seeing from the Biden administration is a desire to kind of adjust some of the tariffs that the Trump administration had imposed on China and which the Biden administration left on.
Meanwhile, U.S.-China trade tensions are sparking once again. The U.S. considering raising tariffs on Chinese electric vehicles. This according to the Wall Street Journal, trying to limit reliance on China's EV industry and shield domestic production. Meanwhile, China moving ahead with banning exports of certain rare earth metals, potentially making it harder for the U.S. and other Western nations to boost their supplies of tech and industry-critical metals and minerals. Joining us now is Bloomberg's Brendan Murray. And I'd love your take, Brendan, on how much of an escalation some of what we're hearing is. The latest headlines coming out fast and furiously, one now saying that the U.S. is planning to gather intelligence on Chinese chip makers.
Yeah, exactly. I think today's news is a good reminder that the U.S.-China trade war has kind of fallen off the front pages, but it never really has gone away. China came out today with what seems like an incremental step to protect exports of rare earth technologies, not the rare earths themselves. The U.S., it's reported, as you mentioned, is considering raising tariffs on Chinese electric vehicles. There already are tariffs on Chinese EVs in the U.S. That's why the market isn't flooded with those products like they are in Europe. But it's just a good reminder that these trade war sort of skirmishes can flare up at any time, and particularly the Biden administration is under a lot of pressure from Congress right now to get tough on China. So they're playing to that constituency as well, heading into election year next year.
There's a real divide, though, right now between businesses and the administration and, frankly, the population when it comes to China. Businesses looking to see if they can have some stability in the world's second biggest economy to continue their businesses there, and the sort of broad-based feeling among the population as well as Washington is sort of against expanding that trade. What do you make in light of that division? Treasury Secretary Janet Yellen heading back to Beijing and yet another time in the next couple of months.
Yeah, exactly. The administration is trying to walk the balance between being tough on China and understanding the reality that American companies cannot decouple completely from the Chinese economy itself. So they're trying to reduce the dependency of American industries on China, but they understand that they can't do it completely, and that many companies still depend on China for their sourcing, even if they shift some production to places like Vietnam or Mexico. So there's a bit of jockeying going on right now to find that balance. How much de-risking can be done from China without it going too far, so as to put American companies at a disadvantage, because the fact is China is still a very capable, productive economy that many economies can't really compete with yet. So it's that balance they're trying to strike, I think.
Brendan, thank you so much. Still with us, I'm so pleased to say, Monica Defend and Eric Knudsen. Monica, how much does some of this geopolitical trade tension type of backdrop really play into how you plan on adjusting your portfolio next year?
Well, definitely, there are a structural component on the way we look at market and fine-tune the active allocation or hedges in place. When it goes to the U.S.-China, our base case is for the relationship to remain calm on the surface. Let's see on the outcome of the the election in Taiwan, to see if any further evolution might be seen there, and then there will be as a big and potential risk the outcome of the U.S. election. So definitely the geopolitical risk is in a radar, but it is not only a risk, but might turn into investment opportunities. If you think about this onshoring, friendshoring, new global disorder that is taking place, actually there are winners and losers. Regions such as India, Vietnam, Indonesia, Brazil, that are going to benefit from this rebalancing of global powers.
Which is the reason why you have seen a bit of a push into investing in some of those regions. Eric, you mentioned something just a minute ago about how one of the potential surprises could be a stimulus package from the Chinese government to try to ignite growth there and to actually see some sort of resurgence of the economy. Are you factoring in any of the trade tensions, or are you thinking that, frankly, people have written off that country to such a degree that it's actually an opportunity at this point?
No, we're still neutral on Chinese equities. That there are a lot of negatives, and we've highlighted a number of those. There are the positives associated with potential to, implement considerable stimulus there, and growth drivers that they have that are quite powerful. We're neutral on the stock market. We do think it's a great security selection opportunity set. What we're watching very closely is the currency as a bellwether of that stimulus, and we've been underweight the currency. We're not at the moment, but that could be an opportunity again. I think what we're looking at, though, is, to echo Monica's comments, is a restructuring of the global trade order. that on the margin is going to raise frictional costs and be a part of kind of higher inflation from a base case standpoint, but also opportunities. We also, like India, see interesting opportunities there. And to echo another one of Monica's comments from earlier, we see great opportunities in Japan, where we're seeing real restructuring in that economy and continued stimulus that we think is creating very interesting opportunities. So kind of playing the non-US opportunity set in a very selective way, and then watching the dollar very, very closely. One of the potential paths for 2024 is a weakening dollar. We're not ready to make the call yet, but it could change the story from kind of US and quality-oriented opportunities to a more non-US and primarily emerging market opportunities.
And that's actually something we were just hearing from a number of investors. Monica, do you agree that the weak dollar kind of trend could gain steam into 2024?
Yeah, definitely. We have these in mind targets around the 119.40 US dollars versus the euro. But in general, with the Fed pivoting and having some asynchrony, in particular between the emerging market central banks that are somehow in an advanced stage of their policy cycle when compared to the US. Definitely, this is going to favor the emerging markets on the full spectrum, from bonds down to equities.
Monica Defend, Eric Knudsen, both of you, thank you so much. Coming up, the morning calls, and later, UK Chancellor of the Exchequer, Jeremy Hunt, joining us to discuss a groundbreaking financial services pact with Switzerland, plus Emily Rowland of Jan Hancock joining us with her 2024 market outlook. Right now, what you are seeing is a lift. We're possibly going to get an 8th straight week of gains. S&P futures up 0.7%, just minutes away, about 7 minutes away from the opening bell. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Less than 5 minutes until the opening bell. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Wedbush raising its Amazon price target to $210 from $180, viewing the company as well positioned to continue taking share of global digital advertising. Next up, Morgan Stanley upgrading extra space storage to equal weight from underweight, saying falling rates may be a tailwind for housing sales and storage demand. And finally, Pivotal Research upgrading Spotify to buy from hold with a price target of $265, seeing continued strong results and an ability to take price without significant churn. Coming up, I am so excited for this conversation. Chancellor of the Exchequer, Jeremy Hunt, on the UK's groundbreaking financial pact with Switzerland to create a closer connection between Swiss and UK banks. From New York, this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Moment news breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Seconds till the opening bell, and you can see that lift continue to persist into the open. We can see a lift across the board, 0.7% for the S&P, up 0.9% for the Nasdaq. The Russell 2000 really leading the charge once again, up 1%. If you take a look outside of stocks, you can see yields lower actually after earlier being higher. 3.83%. The euro getting a lift versus the dollar. Dollar weakness very much across the board, almost to 110. Just a hair away from that, 109.93. And crude prices lower, down 1.5% on the NYMEX, $73.09, after Angola said that it was going to exit OPEC after there was a dispute over some of the production limits they were discussing. One stock to watch at the open is Apple, the tech giant ramping up production of its Vision Pro as it prepares for a February launch. Abigail Doolittle has more. Abby.
This is an interesting one, Lisa, because this would be Apple's first big product launch since 2015 when they launched the Apple smartwatch. And according to sources familiar with this matter, they are ramping up production on the Vision Pro mixed reality headset. I saw a picture of it. To my mind, it looks a little bit like a laboratory pair of glasses, but much cooler with a white frame and then a headset or a band that goes to the back. Now, it sets the stage for a launch in February. Production apparently is and has been for weeks at full speed in facilities in China. And the goal is for customer bound products to be available by the end of January. Now, another reason to think that those close to the matter are correct in terms of potential February launch, they just on Wednesday, yesterday, sent out an email to software developers encouraging them to get ready for the Vision Pro by testing their apps. Now, it will be one of the most, or if possibly even the most complex rollout, given the fact that it requires an entirely new sales strategy. There are a lot of different equipment pieces needed, such as those head straps. It's delicate too, because it has to be fit to your head to work correctly. Costs $3,500. Meta is out there in full force. There hasn't been so much appetite, so it's going to be interesting to see whether or not this one is as successful as they're hoping. They're going to be revamping stores. They need more space to draw people in for that potential February launch of the Apple Vision Pro mixed reality headset, Lisa.
Abby, thank you so much. Turning to earnings now, Micron delivering a strong forecast on the back of robust data center demand. Ed Ludlow joining us from San Francisco. Ed.
Yeah, good morning, Lisa. The stock up now more than 9%. If it closes up more than 9%, that would be the biggest jump since December of 2021. It's all about the outlook for the fiscal second quarter, the current period, $5.1 to $5.5 billion, above street estimates, beating on that forecast. On the bottom line as well, expecting a loss of 21 to 35 cents per share. The street was seeing a loss in the fiscal second of 62 cents per share. The story is pretty straightforward. There's still weakness in end markets like PC and smartphone, but as you said, data center is what's the driver here. There is a recovery in data center overall, but also clear demand on the AI side. Then you look to the bigger picture guidance for 2024. Micron is the biggest US maker of memory chips, and in the AI domain, what is relevant here is what we call high bandwidth memory, or HBM. They are sold out of that for 2024, which is a good indicator that their talk about the demand for AI is real and that it will start to show up in the financials going forward. Then you look at the other end markets. PC, they expect a recovery into 24, low single to mid single digits growth and a modest growth in the smartphone market. But in the PC market in particular, if Micron's right in its assumptions, that would signal 2 straight years of declines ending. They're holding out on production right now while prices stabilize.
Ed, thank you so much. Turning now to China, authorities signing off on the first delivery of a Boeing 787 jet since 2021. Katie Greifeld back for more. Katie.
Hey, Lisa. Yeah, Boeing getting a lift on the heels of that report, according to a person familiar with the matter. The jet expected to fly from Boeing's factory in Seattle to Shanghai as soon as Thursday. And this is an encouraging sign on at least 2 fronts. The first being that it could be taken as a positive signal that U.S.-China trade tensions are maybe easing just a little bit here. And 2, Boeing and Chinese airlines, they've been waiting for Beijing to allow 737 MAX deliveries after 5 years. Remember, that model was grounded globally back in 2019 following 2 fatal crashes. Now, we're talking about the 787 jet here, not the 737s. But Jefferies, for example, has said it expects 737 deliveries to happen after the 787 deliveries. So a step in the process here, Boeing up about 2%.
Katie, thank you so much. Right now in markets, we do see a lift across the board as people parse through data that was better than expected, though still hopes for this disinflationary feel. You could see the NASDAQ up about 1.1%, the S&P up 0.8%, Russell up 1.31%, and really we're looking at yields just marginally lower as everyone parses just how far this disinflation trend really can go. Right now, on Bloomberg TV and radio, I'm Lisa Abramowitz. I'm so pleased to say joining us right now is Jeremy Hunt, UK Chancellor of the Exchequer. Thank you so much for being with us. I am curious, there is this agreement that you just came to. Can you explain why it was so important to come to this financial agreement between Switzerland and the United Kingdom?
Hi, Lisa. Thank you for inviting me onto the show. This is a very groundbreaking agreement. It's never happened anywhere in the world before, and it links 2 of Europe's largest financial centres, the City of London and Zurich. And instead of doing what previous trade deals and mutual recognition deals do, which is try to align legal frameworks, what we're doing here is we're saying that in the UK, we will allow Swiss companies to operate following Swiss regulatory structures and rules, and in Switzerland, they will allow British-based companies to operate following UK rules and regulations. without the need for both countries to align their legal frameworks. And so in terms of the wholesale insurance market, asset management, banking, this is a really significant deal, but also could be a template for the kind of deals that the UK does with other countries going forward.
That's exactly where I was going to go. Chancellor, who's next? What other country?
Well, we're open to discussions with anyone. What I would say is it was much easier to do this deal with Switzerland because there's a lot of trust between Switzerland and the UK. We've been friends for a very long time, and there's a lot of confidence in each other's legal systems and regulatory structures. But we're open to this kind of discussion with any countries all over the world. Anything that boosts choice and competition whilst respecting our sovereignty and our ability to make our own rules and regulations is something we're happy to talk.
Chancellor, how important is this, given the fact that there have been discussions about financial hubs moving to Paris or moving to Frankfurt or Berlin? How much is it important to get some of these connections in order to boost tax revenue and keep the banking sector in the United Kingdom?
Well, we've had a lot of discussion post-Brexit of people, banks, operations potentially moving out of London. But it hasn't materialized on anything like the scale that people predicted. London has shown itself to be very resilient. And if you look at what's happened in the last year, what we've done in the UK is we've shown we're going to be hungry to keep all that business that's come to London. We are very committed to financial services in the UK. We passed the Financial Services and Markets Act. We are changing the rules for prospectuses and for all sorts of the rules around IPOs to make the London Stock Exchange more competitive. We've got the Mansion House reforms, which is going to unlock a lot of capital into growth businesses from pension funds. So we are really motoring in the UK. We're hungry to attract business all around the world. And this deal with Switzerland is just another step in that direction.
How much are you looking to some of these revenues, though, to be able to enact tax cuts? You were talking about additional tax cuts coming down the pike. Are you still planning that? And specifically, where are you planning to have those tax cuts? Is it going to be with the savings or property, other areas?
Well, Rishi Sunak and I have said that we would like to cut the tax burden more if we're able to do so. But we won't be in a position to do that until much closer to the spring budget. We haven't announced a date for that yet. But, you know, we won't find out what the latest forecasts are from the Office of Budget Responsibility to know whether we're in a position to do that for some time. But we would like to bring down the tax burden in a way that is responsible if we're able to do so. But right now, our priority is to bring down inflation. We had really good news yesterday, 3.9% inflation, beating market expectations by some way. That is because we have shown discipline in government. We've taken decisions that have supported the Bank of England in what they're trying to do with interest rates to bring down inflation. And it's still above target. We've still got more work to do. So that will remain our primary focus.
There is a concern about strikes. There was another strike shutting down some of the train systems recently. That was some of the reports this morning. Doctors are striking again. Are you prepared to start to materially increase salaries at a time when you're still concerned also about inflation?
Well, that's a very important question to ask. And what I would say is, I'd put it the other way around, actually. I would say the reason why we're having these strikes is because when I became Chancellor after what Putin did in Ukraine, we had inflation of 11.1%. And people can see their living standards eroding because the price of the weekly shop, the price of filling up the car is going up. So the way that you bring back industrial harmony is to bring down inflation. And that is why it is the primary focus for myself and Rishi Sunak. And when it comes to talking to junior doctors in the NHS or train drivers, we're always prepared to be reasonable, pragmatic and sensible. We've always said we're not going to agree to pay deals that threaten our progress in bringing down inflation, because that doesn't help anyone if you agree to pay deals that mean that next year's inflation ends up being higher. But, you know, we are willing to talk to anyone at any time to try and come to a reasonable solution. And that's why more than 1 million employees in the NHS have agreed to deals. why unions in many other parts of the economy have agreed to deals, and we hope the small number of unions that are holding out will also do the same.
I do want to just finish up from a markets perspective. The markets are now pricing in almost 6 rate cuts by the Bank of England next year as they look at the pace of disinflation. Is that your base case as well?
Well, chancellors never comment on interest rate movements for reasons that you'll understand, Lisa. But what I will say is that I think people will start feeling more optimistic about their own family finances when they can see interest rates on a downward trajectory. And the best thing I can do is to support the Bank of England in their efforts to bring down inflation. And that's what I'll continue to do.
And if inflation goes down, does it give you more headroom to cut taxes?
Well, if debt interest payments go down, then potentially that gives me more headroom, and I could use that in lots of different ways, but I would never use it in a way that compromised the battle against inflation.
Jeremy Hunt, Chancellor, thank you so much for being with us today, and hopefully we'll speak with you again soon. Coming up, media giants Warner Brothers and Paramount teasing a possible merger.
We do think that reaggregation on the streaming side is inevitable. It will likely take some time to play out, but this potential consolidation or whatever permutation you want to throw out there is all one step closer to that end goal.
That coming up next, and we'll catch up with John Hancock's Emily Rowland. All of that coming up. This is Bloomberg.
Let's get to the stories that set your agenda.
Taking you from the U.S. markets close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
these companies are in a challenged position right now because of the debt loads that they have. And that has limited the flexibility that these companies have as they're coming through this streaming pivot that they're looking to make and trying to get to the other side with the pressures of the linear ecosystem going against them.
MoffettNathanson's Robert Fishman weighing in on a possible merger between Hollywood giants Warner Brothers and Paramount Global, with both companies struggling to adapt to the rapidly evolving streaming landscape. A conglomerate is now reportedly on their list of, quote, strategic solutions. The resulting empire would likely face intense scrutiny from regulators. Ed Ludlow back with us from San Francisco. On one hand, regulators don't want probably tie-ups. On the other hand, how much is this just a recognition that some of these media giants cannot survive unless they connect together?
All of those logics are outlined in the sell-side reaction. On the one hand, they're saying, well, you have kind of the two most stretched assets in media right now, most under duress. There is a logic, including from Bloomberg Intelligence, adding to this voice, saying that a combination makes sense. Then you go to the valuations of both companies, the balance sheet of both, and ask how on earth would they get a deal like that done? And then I think antitrust is probably the top of most people's minds right now, Lisa, because of the environment more broadly. I think back to Sun Valley earlier this year and the idea that everyone was micro-focused on Microsoft buying Activision. Imagine if this idea had come about then. Even at that time, people would have said, no way, not in this environment.
And that's the reason why I think that people are reconsidering now. Ed, thank you so much. Right now, John Hancock's Emily Rowland looking into next year, writing this: volatility often creates opportunity. And if equity markets see downside moves in the face of a correction, the math may once again look compelling. Emily, I'm so pleased to say, joins us now. Emily, I was reading your note. I found it fascinating that you pointed to the earnings and said a lot of this year has been looking ahead to next year's hope, but this year's reality hasn't been that great. How much do you think that people really have recognized the reality of what the balance sheet shows?
Yeah, Lisa, it's really amazing. You know, if you look at the S&P 500's return so far this year, up 25+%, that's actually on 0% earnings growth. You look at the tech sector this year, up 58%. That's coming off of 5% earnings growth. So the fundamental support just hasn't really truly kind of justified the amount of multiple expansion we've seen. You know, we started the year at about 16.5 times forward earnings. On the S&P 500, we're sitting at 19.5 today. We're kind of edging up near the highs of the year there. And we're looking at an environment in which, you know, we've seen earnings estimates revised higher to the tune of 6 to 7% here. So there's a lot of optimism that's already baked into shares. We've seen the best of both worlds with multiple expansion and earnings estimates being re-rated here. So the starting point, the math on equities just isn't all that compelling to us. Meanwhile, if you look over to the fixed income side, and bond yields are basically sitting right around the same point that we started the year. So we haven't seen bonds become more expensive the same way that stocks have.
Which raises this question you said in your recent notes. We see the risk reward as less favorable for stocks going into 2024 than we did coming into 2023, when valuations were lower and earnings estimates were more reasonable. A lot of people, Emily, are saying that they're leaning into stocks over bonds because of the Fed put. Are you going in the opposite direction, into bonds and away from stocks?
Yeah, it's hard to fight the crowd right now, Lisa. It's just been unbelievable the way that this Fed pivot party has been playing out. You and I have been talking about this over the course of the last couple of months. A couple of statistics Charlie Bolello tweeted yesterday. The Russell 2000 is up 24% over the last 36 trading days. That is one of the biggest small cap rallies in history. The S&P 500 is up 16% over the last 36 trading days. One of the biggest short-term rallies we've seen in the last 30 years. It's unbelievable to see this optimism that's being priced into markets due to the fact that we saw Chair Powell come in very, very dovish relative to expectations last week, and the party continues here on disinflation. It's hard to fight the crowd right now. We've been invested. We've been overweight large cap equities, overweight U.S. versus international stocks. But when we look into next year, we want to find areas that are not trading at these elevated valuations. On the equity side, we're looking at mid caps, which we think will benefit from reshoring, onshoring, which another guest of yours talked about earlier this morning. And again, high quality bonds over credit. think about things that have become more expensive. Credit spreads just compressed by 130 basis points over the course of this year. It's just remarkable to be at around 330 basis points over treasuries right now. Just no risk priced in to the credit markets today.
Are you concerned about the way that trading has transpired in markets, Emily? We were talking with Peter Scheer of Academy Securities earlier this morning, and he said what it showed us yesterday at 2:30 p.m. when all of a sudden S&P just went off a cliff and stock valuations tanked. It really showed you that there was a skittishness and people trying to explain just thin liquidity and some pretty violent moves. Does that bother you?
It does, and I think there can be a technical element to a lot of these moves, and there's certainly been discussion around that over the last couple of days. It's tough, you know, as we approach markets. Matt Miskin and I at John Hancock, we're fundamental investors. We look at earnings trends, and we look at the macro environment. We look at the data, and yesterday afternoon we're sort of combing through the data, trying to figure out what caused that big move in markets, and it was really tough to pinpoint. I'd say, frankly, over the entire course of 2023, being an investor that's focused on the macro environment and the fundamentals, which we've gotten right, has not been very helpful over the course of this year, as markets have been almost entirely driven by sentiment. So, you know, as Matt and I look back on the year, we're pleased overall with how a lot of our calls played out. But I'll tell you, it's been a year of incredible frustration as across asset sort of dynamics that are playing out just really haven't matched up to what the macro backdrop is telling us.
I hear you, and your frustration is reflected by a lot of people. Into next year, from a macro perspective, putting markets aside, what do you think the biggest risk is? A reinflation of some sort, or a stickier inflation, or some sort of deeper downturn in growth?
Yeah, I mean, I think it's tough to see a significant reacceleration of inflation. I certainly think, you know, Chair Powell, you know, I think that's the biggest question that came out of the meeting is if we have this dovish approach, and we are seeing some of the economic data kind of reaccelerating a bit at the margin here, does that potentially reignite inflation? We think that that would be probably unlikely, given the fact that, you know, these pandemic era distortions that we saw are unlikely to be repeated. So I wouldn't think that that would be a huge risk into next year, growth being a much bigger one.
Emily Rowland, thank you so much. Happy New Year. Happy holidays.
Happy New Year.
We appreciate all your contributions. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
This is Bloomberg.
26 minutes into the trading day, time now for the Trading Diary. What you need to be watching this week. Nike earnings coming after the closing bell. Friday, we'll get the PCE deflator and durable goods orders, followed by new home sales and Immerse sentiment, plus the U.S. bond market closing early for the holidays. And we do wish you a very happy holidays as we wind down the year of 2023. This was a Countdown to the Open. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City.
In London, in Sydney,
from Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True, what the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, Vince Signorella, he's a macro strategist for Bloomberg News. He's in studio. We're going to break down what's happening in these markets because they've been ripping for the last 7-8 weeks. We're going to get his perspective. Then Robert Fishman, one of the top media analysts on the street from Moffett-Nathanson. Again, one of the top media TMT firms on the street. He's going to discuss the potential merger of Paramount Global and Warner Brothers Discovery. Ann Maletti, one of my all-time faves, Allspring Global Investments, head of active equity. She's going to join us to talk about the markets, get her perspective there. Lorene Gilbert, CEO at WealthWise, is going to join us to give us her thoughts for these markets here and what she's telling her clients for 2024. But first, let's kick this thing off with Amy Morse.
All right, thank you, Paul. Markets responding to key inflation data points, including dovish GDP numbers for the third quarter and better than expected jobless claims for the past week. And, you know, Citigroup decided to exit the distressed debt trading business, the latest retrenchment in Chief Executive Officer Jane Fraser's efforts to reshape the firm in pursuit of higher returns. We get more on that with Bloomberg's Catherine Doherty.
They're just showing that they're going to put all of their resources elsewhere. So they still have high yield credit trading, and that likely will remain. But distressed debt is a very specialized part of the credit market.
Bloomberg's Catherine Doherty there. And right now, Citigroup shares are about 1% higher. We do check the markets for you all day long here on Bloomberg Radio. S&P up 0.8% or 38 points. NASDAQ up 0.9% or 134 points. And Dow up 0.7% or 246 points. The 10-year Treasury yield at 3.86% and the 2-year yield at 4.33%. NYMEX crude oil 0.8% lower now. That's a drop of 64 cents, now trading at $73.60 a barrel. COMEX gold at $2,053.30 per ounce. That's a gain of $5.40. And CarMax now topping expectations. CarMax is up more than 7%, almost 8% now. I'm Amy Morris, and that is your Bloomberg Business Flash. Now here's Bloomberg Markets with Paul Sweeney and Emily Graffio.
Very good. Amy Morris, thank you so much. We appreciate it. Emily Graffeo, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Radio. Emily, thanks so much for joining us again today. A couple days in a row.
I know.
Awesome. Very good.
I'm happy.
Good to have you here.
Happy to be here.
Emily's from Bloomberg News. She covers all the markets. She knows what she's talking about. So we appreciate getting her for the next few hours. All right, let's look at the 10-year Treasury. I mean, as Tom Keene would say, in a cup of coffee ago, it was at 5%. Now we're at 3.86%. You know, I got the S&P 500 off that October low up 16, 17, 18%. I don't know what it is. And it's just been ripping here. I don't know what's going on. I'll take it. My 401k is happy. But I want to find out, you know, really what's behind this. Let's turn to a professional here. Bloomberg market strategist Vince Signorella joins us here in studio. Vince, what do you make of this big move here over the last, kind of 7-8 weeks?
You could just talk about the last 24 hours, actually, which have been very, very exciting. I think one of the things we're seeing is, the inflation data is coming down. In 20 months, PC's lower by from 5.5% to 3.5%. The trend is there. One point I would like to make that I think that's being overlooked by markets, there's this constant talk of the traders are getting ahead of themselves, putting in 3 cuts for next year, 5 for the year after. I would just say, forget about how many times the Fed is going to cut. They're going to cut 3. They're going to cut 5 at some point. Just the fact they're going to cut is what markets should be keying on. And I think that's what the equity market is keying on, and that's why stocks are higher, because the Fed has turned the corner. When it happens is less important than that it is happening.
What about the magnitude then? So it doesn't matter if we get 3 cuts or 6 cuts, especially for bonds too, because I hear some people say, well, now the risk reward for a soft landing for bond investors is not very good because a soft landing has been priced in. We really need a recession, a hard landing, 6 cuts for the bonds to do well.
I think you would need like 5 or 6 cuts for the long end to do well, but I think the 2-year on end is going to do very well regardless. I think you're going to have some sort of persistent inflation simply because of the size of the money we owe, $33 trillion, and the size of the Fed's balance sheet has to shrink. I think you're going to just get a steepening of the yield curve, but the shorter end is where it's going to be because the Fed can cut and bring rates down in the short end, but the market may maintain rates higher in the longer end to compensate for a return of real rates.
How about the dollar? I'm looking at the Bloomberg Dollar Index off about 4.3, 4.4% over the last couple of months here. What's happening there?
Very simply, the Bloomberg Dollar Index has a magnificent inverse correlation to the S&P 500, and as you see the S&P 500 go up, you see the dollar go down. Bring lower rates along with that, and it's a double bubble weighing on the dollar, and that boosts emerging markets. So it's a good thing for EM. They need
boost emerging markets, and it means we have to talk to Damien Sassower.
Well, that's you do. I do.
Yeah. Okay. Yeah, exactly. All right.
So we started talking about the last 6-7 weeks, but let's zoom into the last 24 hours because what happened yesterday? All of a sudden, I look at my screen, S&P's down like 1.5%.
So
out of nowhere.
And I would say bless the squawk product. If you don't listen to SQUA Go, you're missing something. Because I actually said over this, I talked to traders all day. The market's moving, and I have no indication of what's going on. Immediately got an IB from a very heavy trader at a very heavy shop who I won't name, who told me about an option trade that went through at about 47.55, which drove it. And what it was, they're called zero DTE options. They're zero standing for zero days.
Okay.
So they expire same day, 4:15 p.m. into the 15 minutes after the close into the futures market. And so it's a zero, zero expiry option.
Right.
We used to call them one-day trade expiries. Now there's zero-day trade expiries. The trade was put on at around 47.55. It was about 8,000 lots. It translated into a cash position of $1.9 billion. So when this trader, whoever, hedge fund, whatever, put this on, put essentially $1.9 billion in the market, that had to be essentially just puked. And that's exactly what happened. As the market got lower and the trade got more and more in the money, more and more people had to cut positions, and there were a lot of weak longs out there. As you mentioned, we'd gone up a long way in a short period of time. So all those weak longs got chased out. We traded below 4,700. But again, it's a zero-day expiry. It's gone. So now we're going to trade back and see if people still have some of those positions. That might limit the upside for a while until this all gets cleared out. So we could see a little bit of back and forth for the next week.
Just from a trading perspective, is the market a little over its skis here, just from a trading perspective over the last 6, 7, 8 weeks?
Yeah, I mean, you could say so, but, the tell on that is going to be where earnings come in the first quarter. It's hard to say. You could say the market is all this built-up momentum from the Fed having rates for so high for so long. And if you legitimately believe that the cuts are coming and what magnitude they are, that's going to help spending. It's going to help earnings. It's going to help a lot of things. The big thing to look for is what happens in the first quarter with revolving credit and delinquencies. Unfortunately, loan delinquencies are beginning to go up, and even in the auto space, which is a very bad sign. So if folks have overspent for the fourth quarter and can't keep up with pace, you might see that little pullback in the first quarter, that soft landing / recession that everybody's talking about.
All right, Vince, thanks so much for joining us.
Thank you.
Vince Signorello, macro strategist. SQUA Go is the squawk, real-time market commentary throughout the day. That's what Vince and his team do for you. And again, really, really valuable for folks in the marketplace to get some real-time feedback from the trading floors and the trading desks around the street. So good stuff there. All right, here's a deal, Emily, in my wheelhouse, or potentially. Looking at Paramount Global, that's the old Viacom, CBS, and Warner Brothers Discovery, again, the old Time Warner stuff, plus the Discovery, that merger, David Zaslav is the CEO. Maybe those two companies getting together, which would be really interesting. Robert Fishman, he's a senior equity analyst at MoffettNathanson, and Robert's a longtime street analyst. MoffettNathanson, pound for pound, the best TMT research on the street, in my opinion. That's why we like to talk to those guys when we can. Robert, thanks so much for taking the time to chat with us here. Give us the rationale for a potential hookup between Warner Brothers Discovery and Paramount.
Sure. Thanks for having me. Well, again, this is all speculation at this point. I mean, the reports suggest that they clearly met this week. In terms of the logic behind it, I think it really just comes back to the fact that traditional media is really starting to get more desperate. And why I say that is that the realities of the fundamental business at hand, with linear advertising falling off a cliff and cord cutting continuing to accelerate, and the costs of switching and pivoting over to streaming has really challenged a lot of these companies. So now they're all looking to figure out how can we try to get stronger. And the way that it seems most of these companies are trying to do that right now, at the very least, is try to have conversations to figure out who they can combine with.
Robert, how do you see this deal going down, this potential deal in Washington? It doesn't seem like the antitrust regulation would be very welcome to a potential deal this large.
Yeah, we were surprised by the timing of these conversations, and really comes back to two key points. Number one, there's a 2-year lockup right now for Warner Brothers Discovery as part of its last deal with Warner Media and AT&T to come through on the other side of the Reverse Morris Trust. So that leads you to April 24. But then coming back to your question, given the regulatory landscape right now, it's hard for us to see how any deal would be approved in the current administration, or at the very least would have significant review. And we pointed out in our report this morning the overlap between the linear cable networks and broadcast, just from a viewership standpoint, would be something that clearly would be looked at a little bit more closely, I think, given the potential combination.
Hey, Robert, nothing gets done here unless Sherry Redstone gives the green light. Sherry Redstone, the chairperson of National Amusements, which is the control shareholder of Paramount. Do we have any reason to believe? I mean, she could have sold these assets at any time over the last 6, 7, 8 years at a drop of a hat. Why now do you think she might be open to a transaction?
It's a really great question. What we think is leading to all of this now is, again, like the realization as far as what the trajectory of the business is going forward. And I alluded to a couple of the headwinds facing the traditional business already in terms of advertising and cord cutting. But another big piece coming up is the renegotiations with a few of their affiliate distribution partners, and namely Charter. And if we all remember what happened with Disney just only a couple months ago, we do think that this is going to be the template that at the very least Charter and more likely other distributors are going to look to take going forward in future negotiations. So that will put an additional pressure on companies like Paramount, which we've essentially labeled them as one of these cheaters of the ecosystem.